Good evening, everyone. And first and foremost, thank you for joining in here. And we are officially looking at starting our marathon session from today onwards. Okay, brilliant. Well, I'm just trying to take the. Okay, there you go. Okay, super. So, guys, this marathon is specially primarily targeting students sitting for December exams, and I'm sure all of you in here are students from the December exams, right? For the ones who know me, you really know me, but for the ones who do not know me, I am. Oh, I am Ziyan. I've been tutoring for the ACCA subject ACCA over the last how many years? Over the last 10 years. I've been teaching across different countries, particularly students coming from India, Maldives, Vietnam, Colombo, Sri Lanka, and oh, why can't I update this? Is it okay? Is there any problem in here? Okay, let me move to trash. But I think this is not the updated version, is it? Can I do it at least now? Oh, no. What's happening? Do we have any way I can upload it? Okay. At least let me take it on explain. Okay, there you go. I've been producing prize winners almost in every exam session. And last session I had world number 2 for FR and world number 1 for audit and assurance. Okay, that's a little about me, but I'm not gonna go too much into it. But today it's primarily about our December exams, right? Now, when you take the December exams, like you already know, we've got section A, we've got section A in our syllabus, we've got section B in our syllabus, and of course, we have section C, which is going to be 40 marks in the exam. Section A and B put together will be 60 marks, made up of MCQs, multiple response questions. We've got drag and drop options, number entry. So we've got different aspects in terms of section A and B. However, when it comes to section C, it is going to be 40 marks, but primarily, we see your examiner is testing these areas. What are your areas? Ratio analysis is one of your examiner's favorite areas, but students mess up there. Students mess up ratio analysis. Number 2, consolidation is one of your examiner's favorite areas, but to a major extent, students are getting it right. And of course, company accounts. Company accounts is income statement, balance sheet. Yeah, students are fine with that. But students, most of the time, they panic with ratio analysis. So my marathon session is primarily trying to touch these areas, right? These three areas. But when I'm touching these areas, by default, when you take company accounts, I will be touching section A and section B as well. So as much as possible, the objective of this marathon is obviously whatever you studied over the 80 hours period, 80 hours time frame, to simplify, to bring it within a week. So we've got about 15 days for the exams. Today is the 18th. So we've got about 15 days for the exams. I'm trying to shorten, squeeze things. So I'm going to be quick. I'm going to be fast. I'm going to be quick. I'm going to try to see maximum how we can utilize the time period. But before everything, everybody with me, do you understand? Are we ready for it? Yes or no? Are we ready for it? Yes or no? Everyone. You ready for it? Super. Uh, guys, Guys, like I told you, one of the primary areas of today's session is going to be my ratio analysis, which is our primary area. I'm gonna take you through the theory, and I'm gonna try and do a question with you. Clear? Brilliant. Okay. You can of course take notes, no problem, and I will also try to share whatever I'm doing here to you so that you can also use them. Brilliant. Guys, we're going to quickly look at interpretations. Interpretation, the term means you're trying to comment on what has happened in terms of the financial statements. Now when you take the financial statements, I'm talking about the income statement, I'm talking about the balance sheet, the statement of financial position of the company, cash flow statements of the company, statement of changes in equity. So you're going to take everything and you're going to interpret means comment. You're going to give comment. So don't worry about your language, don't worry about your English, don't think, oh, I don't know if my language is correct. No. What matters to the examiner are your points. As long as you can give proper points in the exam, you should be fine. So basically what I'm going to do is I'm going to take you through some points in terms of interpretations, so that crystal clear it goes into your head. Okay, these are the things that you need to keep in mind, so when you get in the exam you can work around these areas. Brilliant. Now under interpretations, one of the primary things that you probably be getting is interpretations: profitability of the company, are the company profitable or not; liquidity, what is the cash flow position of the company; and then we're talking about gearing. Working capital gearing is what is the financial risk associated with the company. So first I'm going to talk to you about profitability. So profitability speaks about what is company's profit, are the company's profit making, the company is not profit making, what has affected revenue, cost, where do we have to manage in terms of increasing the profitability, or in the past what has happened, the company has the profitability has come down, the company is making losses from profit to losses or losses to profits, the reasons. And a primary ratio that your examiner expects you to know is your GP margin. Your gross profit margin is your gross profits over revenue into 100. Guys, you need to memorize it. You need to know it in the exam. Sometimes your examiner gives it. Most of the time, no, you don't get it, but you need to know it. So your GP over your revenue into 100 is your ratio. Make sure you know it entirely. That is number one. Your GP margin. Okay, I'll write it for you. Yeah. Your gross profit over your revenue into 100. That is the ratio that you need to keep in mind. Why can there be a fluctuation? Why can there be a fluctuation in your GP margin? Why your GP margin can come down or why it can go up? It can be affected by few variables. First variable that you can keep in mind is your selling prices. Your selling prices obviously will have an effect in your GP margin. Why your selling prices is connected to revenue, so that can have an impact. So you have to keep that in mind. Number two, your sales mix can have an impact on your GP margin. Number three, your purchase cost can have an impact on your GP margin. Your purchase price can have an impact on your GP margin. Obviously, because when you take gross profit is after cost of sales. Cost of sales has this purchase cost in it. And of course, if you are producing, you have your production cost, which can have an impact. That's something that you need to keep in mind when it comes to your GP margin. Yeah, are we clear, everyone? Yes or no? Are we clear? All right. Now, secondly, the second thing that we probably will have to be talking about in the exam is going to be our operating profit margin. So operating profit margin is made up of profits from operations, operating profits over revenue into 100. So our operating profits over revenue into 100, that can have an impact on our operating profits margin. How can our operating profits margin be affected? Why can there be a fluctuation? Number one, because of our gross profit. Our gross profit can have an impact on our operating profit margin or our expenses. Number one, GP, gross profit, or number two, our expenses. Our expenses means I'm primarily talking about, if it's operating profit, it's admin and distribution. Super. Number three, our third ratio that can be tested under our profitability is our asset turnover. Now, coming back, our asset turnover speaks about how much of revenue our assets are generating. We have got our revenue. So our revenue is generated through our assets. So how much is it generated? How do we calculate? It is calculated based on revenue over our capital employed. So when you're taking capital employed, you normally take your equity plus long-term liabilities, long-term funding. So that is our asset turnover. And why can our asset turnover have an impact? Why can it fluctuate? Our asset turnover can fluctuate because obviously, revenue increase or decrease can have an impact. So revenue goes up or comes down can have an impact. Number two, capital employed, speaking about non-current assets, increase or decrease can have an impact. And obviously, number three, our working capital. Our net assets, we're talking about net assets, capital employed. Yeah, capital employed. So basically, our working capital increase or decrease can have an impact. 1, 2, 3. And one of the other primary ratios that we have to be very careful in the exam is our ROCE. ROCE is one of the primary ratios for a shareholder. So as a shareholder, you're putting your money in. For the money, the capital employed, what is your return? So that is calculated as operating profits over capital employed as a percentage. Okay, now what is ROCE? For the money that we have invested, capital employed, the profit that we are generating. Where can we have an impact here? Our ROCE can be affected through our efficiency. How efficient are we in terms of generating profits? Number two, profitability, or movement in operating profit margin. Our operating profits going up, coming down, or it can be combination of both. So our ROCE is affected by number one, efficiency. So movement in asset turnover. Our asset turnover, this particular thing, asset turnover can have an impact on our ROCE. Number one. Number two, movement in asset turnover. Number two, profitability. Profitability means in this case, I'm talking about operating profit margin, because here we are talking about operating profits. Movement in operating profits can also have an impact on our ROCE. So, operating profits. Are we clear? Are we clear? So, when we are talking about ROCE is connected with your asset turnover. Your asset turnover, which is your revenue over capital employed, and your ROCE is connected. What is the connection? Your operating profit margin into your asset turnover gives you your ROCE. Your operating profit margin is your profitability. Now, when you're talking about ROCE, that is about profitability, and your asset turnover is your efficiency. So you both put together, you will still get your ROCE in the exam. Okay, are we clear? Are we clear? Okay, this is the first part of our profitability ratios that you got to keep in mind, relevant for your exams. Okay, brilliant, understood. Okay, now if you can keep this in mind, the movements and how this is affected, that is one way you can work around in your exams. That is one way you can work in your exams. Okay, worst case, if you don't understand the logic, that's okay, memorize it and try to connect it in the exam. In the exam, connect it with the scenario. I will do it with a question so that you will understand it better. Okay, now that is our profitability ratios done, which is relevant for your exams. Number two, I'm trying to get into the liquidity ratios. So, liquidity ratios. Okay. Now, when talking about liquidity ratio, one of the most important is your current assets over your current liabilities, your current ratio. In the exam, I see this very often. So, you need to know your current ratio. Your current ratio is your current assets over current liabilities. How much of your liabilities can be covered by your assets? Because at the end of the day, liabilities are payables within next 1 year. With our current assets, how can we cover it? How can we cover it? Okay, I've noted. I'm getting so many questions. I'm noting. But guys, you need to understand. This is not a fully fledged class for me to sit and do all the questions that you give me. I'm so sorry, I won't be able to do that, but I will try to cover as much as possible for the exams. But if you want me to do it personally, then we can look at it personally. Here I have a time restriction. Okay, so current ratio is my current assets over current liabilities. That is one important ratio. How can your current ratio? Okay, current ratio can also be connected to our quick ratio. Our quick ratio is also very similar, but with one difference. You have to exclude inventory. So basically, when it comes to quick ratio, please take your current assets less inventory, exclude inventory over our current liabilities. Yeah, and then your changes in your current ratio or quick ratio can be due to few things. Number one, movements, ups and downs, movements in cash balance can have an impact. Obviously, current assets means inventory, receivables, and cash. So movements in cash balance, trade receivables, and inventory. That is not one factor. Second factor, movements in trade payables can have an impact. So what you have to do in the exam is go and check what has affected, what has made an impact, and you have to try to work around it. And next ratio that can come under liquidity probably is your inventory turnover. Your inventory turnover is your cost of sales over inventory, right? Inventory turnover is different to inventory holding period. Okay, now when it is inventory turnover, you're talking about number of times your inventory has been changed, has been turned over a period of time, right? So number three, your inventory turnover. How quickly are you using your inventory? How quickly are you selling your inventory, in other words? So your cost of sales over your inventory. So you're looking at the efficiency. How efficient are you in converting your inventory into cash? In other words, higher efficiency gives you higher turnover. There you go. Next point, your inventory holding period. So that is number 3, and number 4, inventory holding period. Very frequently tested. Obviously, you know, inventory over cost of sales into 365. This tells you on average how long are you holding on to inventory, right? How old are you? How many days are you holding on to inventory before it gets sold to your customers? If you have lower days, it means it is high efficiency. Here basically high turnover means high efficiency. Here in this case, lower number of days, because we are trying to convert it into days. Lower number of days gives you higher efficiency. You're holding on to inventories less time. You understand? So lower days gives you higher efficiency. Are we clear? Are we clear? Okay. Now, how can your inventory ratios change? Why can there be a movement? Because of improved or very bad inventory control. Your inventory control system is very bad. That is number one. Why can there be a change? Number one, inventory management. You have to question the inventory management. How best are you controlling your inventories? Number two, damaged inventories. So these can have an impact in terms of our inventories. Under liquidity, number four, 1, 2, 3, 4, 5. Number 5, I can talk to you about in the exam. We can talk about trade receivable days and trade payable days, right? Now, trade receivable days is going to be trade receivables over revenue into 365 days. Now, what does it mean? On average, how long am I taking to recover my trade receivables? Am I quickly recovering my trade receivables, or am I taking time to recover my trade receivables? Now, basically, the longer I take, the longer my cash is with another person, meaning my liquidity is affected, my cash flows are affected, my working capital is affected. So basically, lower trade receivable days means higher cash conversion. So basically, keep that in mind. If it's lower days, I have good control over the credit period, right? I have very good control over the credit period. If it's higher days, my credit control is very, very, very poor. So better to have good days, smaller days. And also, it also means that I can have irrecoverable debts the higher the number of days. So few things, credit control management. Number two, number one, number two, irrecoverable. Debts. Are we clear? Are we clear? Everybody, are we clear? Okay, there is a question. Is it on revenue or credit sales? It's on credit sales revenue. Okay, on how, because obviously credit sale is what is relevant for you in terms of checking how quickly are you receiving your money, right? So obviously, it in simple terms, it measures the number of days that you can collect the payments from your customer after a sale. No, so after a sale, if you receive the money, then there is no point. No, so it is with credit sale. Are we clear? It is with credit sale. Are we clear? Somebody had asked, I don't know. I'm getting a lot of messages, so I don't know where, but I just saw. Okay, fine. Okay, got it. Okay, so now number 5 that is done. Number 6, I'm talking about number 6. We're gonna come back to our trade payables period. So trade payables obviously are credit purchases, trade payables. So payables over credit purchases into 365 days. So in the exam, you can consider cost of sales as a substitute alternative to credit purchases. It is okay. In the exam, it's fine. Arutra, let me see what I can do. No problem. I've seen your messages. Let me see. Arutra, I'll try to pick whatever comes in. Okay. But it's not based on just one particular thing. I'm forecasting something for the exams. So it will be based on that. But if you're doing that question and if you have any problems, please let me know. I will individually help you. Right? Because I see you sending me a lot of questions. I don't think I have enough time to do all those questions. If you have doubts, I can clarify. No problem there. Don't worry. So coming back, trade payables, it's about average number of days that I take to pay my suppliers. Basically, I'm holding on to cash of my suppliers. I'm holding on to their cash with me. So the longer it is, it's better for me because I've got cash flows. Basically, there are companies, what they do is they hold on to their payables, whatever they have to pay cash, and they do a small investment, a slight investment. So yes, obviously there can be issues with that also, that where you can lose negative goodwill, that you can create a negative goodwill. There can be so many reasons why your trade payable days can move up or come down. Probably you've got an extended credit agreement with your payables. It's a new supplier. Sometimes you're smart. You invest the money. Sometimes you're not smart. You take that money and you go on a family trip, meaning you're finding it difficult to pay off your trade payables on time. So that the higher the number of days sometimes might create a negative goodwill. Are we clear? Are we clear? Are we clear? Okay. One thing I want to work on this is your working capital cycle. Your working capital cycle. Now, what is the working capital cycle? What do we mean by a working capital cycle? Working capital cycle simply means the period in time for which your inventory is funded. From how you are funding your inventory, the time period of funding your inventory. That is from the date of payment to your supplier to the date payment is received from the customer. That is your working capital cycle. So your working capital cycle is generally calculated as your inventory days plus trade receivable days minus trade payable days. So once again, working capital cycle represents the period of time for which your inventory is funded, for which you purchased your inventory, you're funded from the date of payment to your supplier to the date of payment received from the customer, right? So I'm buying inventory now. I'm holding on to the inventory today, maybe for about 10 days, and I'm selling it to B, and B is paying me in about 20 days. So from the purchase inventory date to the customer payment date, in other words, I am purchasing inventory today, and I am paying supplier. From this point onwards, I have to sell my inventory to receive my cash. Correct? My working capital cycle starts from my paying supplier my money to my customer paying me. This particular period is my working capital cycle. In this, few things will be involved. In this, number one, what will be involved will be my payable days. how long will I take to pay my suppliers? My payable days are involved. That is from this point to this point. My payable days, because that is my payment to my supplier, correct? My inventory days will be from this period to my selling inventory period. This is my inventory days, and my trade receivable days would be from this point to me receiving cash. My trade receivable days. Are we clear? Are we clear? Now this is my entire working capital. Well, my working capital is, in simple terms, inventory days plus trade receivables minus trade payable days. Now basically here the figure that I get represents many things. Number one, it represents, if my working capital cycle is smaller, it means I'm converting my inventory to cash quickly. My efficiency is high. Shorter working capital cycle equals high efficiency. Okay. So how can I bring this smaller? I can bring it smaller by reducing my inventory days and trade receivable days and increasing my trade payable days. So how can I make it shorter? Shorter can be made by less inventory days and trade receivable days. I bring it down, or increase my trade payable days. Arutra, don't worry. I'll try it. Don't worry. I'll actually try to pick a few questions that you have proposed. Don't worry. Take it easy. Okay. Okay. Take it easy. Okay. Okay. Now I'm coming into financial stability of the company. So that's my working capital. That's my liquidity ratios, guys. So there you go. Under liquidity, I've covered current ratio, I've covered quick ratio, I've covered inventory turnover, inventory holding, trade receivables, trade payables, and obviously working capital cycle. I've covered the primary areas with you. And now I'm coming to my long-term financial stability, long-term gearing ratios. In terms of gearing, how can the company's financial stability be evaluated? So my last, I don't think it's not the last, but not the least, I've got investor ratios also to cover. Okay, we've got financial stability ratios. When talking about financial stability, one of the most important things that you need to keep in mind is your gearing ratio. So number one, your gearing ratio. Your gearing means your debt over debt plus equity into 100. Your debt includes all long-term borrowings, loan notes, redeemable preference shares, whatever, redeemable preference shares, loan notes, bank loan, everything comes into place. Equity, share capital, reserves, and if you have consolidation, you will have to take NCI also, non-controlling interest also. Or instead you can also use debt over equity. This is also fine. So high gearing, if it's high gearing, in simple terms, greater risk. High gearing is greater risk, meaning you are funding the company through borrowing. So number one, higher gearing equals greater risk. Number two, shareholders are concerned because your going concern can be affected also. Shareholders worried. If it's obviously low gearing, it's lower risk. Okay. reasons why there can be movement, probably okay, you went for a loan during the current year, you went for a loan, you issued shares, you issued preference shares which is treated as a liability, you purchased assets for lease, can go up or come down. You've got reduction in retained earnings because of some losses that you're making, or you are making excessive dividends to retained earnings. Your retained earnings is affected. If your gearing is coming down, probably you're repaying loans. You're converting loans into maybe converting them into equity, debt from debt to equity, probably, or something like that. Your profits are increasing because of that. Your another reason can be your retained earnings going up, or probably you're revaluing your assets. So because of that, there can be reasons as to why your gearing can also change. Okay, next point, number two, interest cover ratio. Interest cover ratio. Interest cover is your profit before finance cost, PBT, profit before interest, PBI, profit before interest. Yes, I'm going very quick. Okay, over finance cost. So it shows based with the profit that you have, how much of interest you can cover, how many times you can cover. So you have your interest that you have to pay. So from your profit level, how many times you can cover. So you just try to understand your default risk. This shows you the default risk to understand. Okay, as a part of finance, interest cost, can we at least cover it? So that's the primary logic behind it. And apart from that, guys, in terms of financial stability, you don't have to worry. That's the primary things that you need to keep in mind. Apart from that, you need to know EPS. EPS is IAS 33. It's a separate accounting standard. Probably profit attributable to the ordinary shareholders over the number of weighted average shares. You probably know. And your price earning ratio. Your price earning ratio is your current share price over your latest EPS. Apart from that, you will be tested probably with dividend yield, dividend per share over current share. And if you want dividend cover, it's profit after tax over dividends. These are the primary ratios that can be tested for you. Okay, let's get back. Let's get back entirely with a question. I want to do a question with you. Are we clear? But before that, I want you to quickly go through whatever just I've just wrote here. Quickly go through, and if you want, you can take screenshots also, no problem. But have a quick go through, quick, and give me a data. I feel some water and be back. Ziyan, can you please explain how to calculate capital employed? Okay. What is capital employed, Avani, first and foremost? Okay. Uh, your total capital that the company has, which you use to generate your profits. So it's an important metric evaluation of efficiency. Your capital employed. Okay, how to calculate that? In fact, there are actually two ways to calculate that. Your capital employed can either be your total assets minus current liabilities, or your equity plus your non-current liabilities. Amani, are we okay? Are we clear? Your ROC is the obviously a profitability ratio. Right. Super. So let me go back. I am going to look at a question, a detailed question, obviously, which can be tested. Something like this can definitely come in the exam. So I'm going to see how to work around a question like this in the exam, and then we are going to take things forward from there. Okay, brilliant, super. The requirement here, the requirement is calculate the missing ratios in relation to H, calculate the missing ratios, and then write a report for the directors to assess the financial performance. Your performance means you're talking about your P&L, your position, you're talking about your balance sheet of H for the year ended 31st March 2015 compared to the previous year. Your answer should refer to the information above and the impact that Sparks has had during the year. So you have to talk about the information given to you and you have to talk about Sparks. So there are a few things that you're going to talk about. You are obviously going to talk about the financial performance, the financial position of the company. You're going to talk about, you're going to compare your financial statements to the last year, and your answer should have an impact of the information above and the impact that Sparks, I don't know who Sparks is, but you need to keep in mind that some funny guy called Spark or a company called Spark or whoever has had during the year. So you need to keep all those in mind. Okay, super. Now to start off, uh, how do I lock this? Okay, to start off, here you're getting 7 marks. Here you're getting 13 marks. So in total 20 marks we know in the exam. Right, brilliant. Your ROCE calculated, you don't have to calculate. Your GP margin, you have to calculate. Your net profit margin before tax, your examiner says before tax means please go do it before tax. You have to calculate. And then current ratio is calculated. Quick ratio, we know the formula, you have to calculate. Inventory holding period, you know the equation, you have to calculate. Receivable payment collection period, payable collection period, gearing, debt as a percentage of debt plus equity, debt plus equity, debt over debt plus equity. So yes, brilliant. We've got 1, 2, 3, 4, 5, 6, 7. 7 ratios in the exam. Calculation, I get my 7 marks. So basically in the exam, this is how it's going to look like. Wait, trying to connect my keyboard. It doesn't disconnect. There you go, it's showing and it's connected. There you go. So let me also take Excel on my screen. Go. Right. Sustain. And you've got 2015 and 2014. In the exam, how I want you to do the calculations, please listen to me. Guys, this is how I want you to do the calculations in the exam. Listen to me very carefully. Okay. 2014, you have 2015, you have 2 years with you. And then I want you to open up a new section, write your analysis of financial and financial performance and position. I want you to do it like this in the exam. Okay, we have few things to do here. Please try to understand, my dear. Please try to understand, my dear. You are going to talk about, write a report to the directors to assess the financial performance and position of H for the year ended 31st March 2015 compared to the previous year, meaning your last year's ratios are also important. Your answer should refer to the information above and the impact that Sparks had during the year. In the exam, in the real ACCA exam, this is how it's going to look like. This is the exact same way in your exam it's going to look like. Okay, so you have your 2014, you have your 2015. First thing, you have your ROCE, you have your GP margin, and then you have your net profit margin, then you have your current ratio, quick ratio, inventory holding, receivables correction period, payables payment period, and you also have your gearing. Remember, Ziyan has given you for each and every point how to talk in the exam. Ziyan has already given you. Now it's a matter of applying that in the exam. Okay, now I'm going to make it very simple for you. Let's not complicate in the exam. Right here, try to understand. You are going to write a report for the directors, right? So you're going to write a report to the directors to assess. So to board of directors, from you are the IFRS consultant, for example, consultant, subject performance and position analysis of Huston. From this point onwards you can call it H, no problem. Date, so date could be, today is the 18th, is it? Yeah, 18th November 2024. So there you go. In the exam you don't have the option of adding lines, so you'll have to probably copy paste, but there you go. So you can say, dear sir, it's a report, so please make it look like a report. You don't overflow it, but make it look like a report, right? Dear sir, please find below ratios calculated calculated with the analysis done related to H in terms of performance and position. This report is solely for the use of the management of H only, and we do not take any responsibility for third party disclosure. There you go. Just keep it very simple. If it's a report, we'll try to give it like a report. Now that is not going to give me 13 marks in the exam. That is just the structure, my structure. Now only I'm going to come up with my analysis. Okay. Now my analysis requires a ratio calculation. My analysis requires me to go back and read the scenario. Okay, I'm giving you a good 2 to 3 minutes for you to go through the scenario on your own and come in, and then let's work around this question together. A good 2 to 3 minutes, maybe about 4 minutes, I can give you, no problem, for you to quickly go through so that we can cover it quickly together. Once you're done, give me a done, yeah? Once you're done, give me a done, yeah? Done. Okay, let's go further. Done with this also. Look at the additional information. Okay, right. Um, in the exam, yes, you've read the scenario. You know where the information are to start working on your ratio calculation. So I would advise you to start off with your ratio calculation so that you know your understanding is better. Right, brilliant. Your gross profit margin. Obviously, you know your gross profit margin is your gross profit over revenue into 100. 2015 and 14 both are given at 31 and 37%. Your examiner has made our life easier. Oh, wait. I'm starting with ROC. Sorry, ROC. 31 and 37% already given, meaning our ROCE has gone up. Our ROCE has gone up. Keep that in mind. Okay. And next, GP margin. Let's fill in the blanks. 28, 14, 28, 14%. Okay, if you had already started working on 2015, please give me the figures. That's okay. If you've already started working on it, brilliant. I'll be very happy with you. 1.1 is to 1. And then I have 162 days here. I have 69 days here. I have 138 days here. I have 42%. Did I get everything right? 37, 28, 14, 14, 1.1. Okay, 0.4. I'm missing that. 0.4 is to 1. 138, and then there you go, 42%. Oh, okay, I'm getting it wrong. Basically, my 2014 figures are this, and my 2015 figures are here. Okay, 2015 figures are here. Okay, you have to be very careful. Look there, small mistake. Okay, thank you. Headings are changed now. Okay, Abdullah. Okay. Take it easy, take it easy. Don't worry too much. You're there. Okay. Now, I've got my ROCE, and next I've got my gross profit margin. Everybody, gross profit margin. Yes, please help me. Please help me with my gross profit margin for 2015. What's my gross profit margin for 2015? Equals 3840 over 9600. It's approximately 40%, correct? Everybody, are we getting it right? Are we getting it right? 40%? Okay, brilliant. Everybody is getting 40%. Net profit margin, but your examiner has clearly mentioned your net profit margin has to be before tax. So please make sure you get your net profit margin before tax. How much is it? How much is it? Net profit margin before tax is how much? Please get the figure for me. $12.18 over 12.18 over 9600. Is it 13.3%? Is it 13.3%? I'm getting 13.3%. Yes, Kadina says 13. Shadia, please check. I'm getting 13.3%. Correct? Yeah, because your examiner says profit before tax, it's not profit after tax. So please get it right. Yeah, 13.3%. Okay, brilliant. Next, I've got my current ratio. Go to my current ratio here. Current ratio is my current assets over my current liabilities. How much is my current assets? My current assets are here at I think 3400. My current assets are at 3400 and my current liabilities are at 2520. Correct? Equals 3400 over 2520. 1.3:1. Current ratio is given in the question itself, sir. Yeah, it's given in the question. I'm sorry. Yeah, makes your life easy. 1.3:1. Your examiner has given you. Brilliant. Thank you. And your quick ratio. Okay, fine. Now that the current ratio is calculated, can you please calculate quick ratio for me? Because that is not given in the question. Quick ratio for me, please. Quick ratio for me, please. Someone has said 0.6. Can I go with 0.6? 0.4 to 0.6 looks like a slight improvement. Can I go with 0.6? 0.6:1. You know the calculation ratios. Please make sure that you work around it. Okay, everybody, you're getting 0.6, correct? Okay. Now let's move forward. Your inventory holding period. Yes, your inventory holding period. Please go back. Your inventory holding period. Please do the calculations for me. How many days? Inventory holding period. How many days? 114 days I'm getting as inventory holding period. Everyone. Komal, how did you get it? Komal, how did you get your 114 days? How did you get your 114 days, Komal? Show us your calculations. Inventory over cost of sales into 365. Guys, everyone, please confirm inventory over cost of sales into 365. Inventory is here. Cost of sales is here into 365. Are you getting? Are you getting? Yes, that's right. Inventory is 1800. Your cost of sales is 5760 into 365. Right? If your calculation is correct, that means 114 days has to be correct. Equals 1800 over 5760 into 365. 1800. 114 days, correct? Yeah, I'm also getting that. 114 days. That's okay. receivables collection, that is your trade receivables over your revenue into 365. Your trade receivables over revenue into 365, that's your trade receivables. You got to be quick in the exams, and that's your revenue. Please give me your answers, please can I have your answers? Trade receivables over revenue into 365. Can I please get your answers? Okay, I'm getting 29 days from few students, so I'm going with 29. I'm not going to make a change there. Trade payables payment period, so that's your trade payables over your purchases is not here, so your cost of sales. Your payables is given to you. Your payables is standing at 1680. Your cost of sales is 5760. So how much is that? How much is that? Payable days is how much? Komal says 106 days, so I'm gonna go with 106 days. He's got few correct, so I'm gonna take some trust. Okay, Amani says 106. Okay, fine. And then we've got gearing, but our gearing, they say, examiner says that gearing is going to be debt as a percentage of debt plus equity. So debt as a percentage of debt plus equity. So there you go. Look at your debts. How much are your debts? How much are your debts? Your debt plus equity. Your debt over debt plus equity. Your debt over debt plus equity. Please take your long-term debt. My screen is blurred. Is my screen blurred, guys, by any chance? Is my screen blurred? Okay. Give me a moment. Is my screen blurred? Numbers are not visible. Okay. Now do you see it? Now do you see it? By any chance, now are we good? Are we clear? Yeah. How many percent? Okay, now it's clear. My debt, my debt, long-term debt over debt plus equity. Please ignore, not required. Any answers? Any answers? Okay, why do we ignore deferred tax, sir? Because it does not give us a direct obligation to pay cash. There is no direct obligation. Because of that, we ignore when calculating debt to equity ratios. Yeah, are we clear? So you can take all liabilities, can be loans, bonds, any obligations where you have a repayment obligation, okay, because you are trying to understand the financial leverage of the company. So in other words, how much is the company funded through debt in comparison to equity? Are we clear? And when you take deferred tax is a temporary difference between your accounting written down value and tax written down value. It's more of an accounting entry for your future tax liabilities and assets. And technically, there's no cash involved. It's just an accounting entry. That's the reason. Are we clear? Are we clear with that? Okay, but most of you says 31.7%. So I'm going to take 32% as my gearing ratio. Super. There you go. I've got my 7 marks in the exam. I'm going to start off with my analysis. But remember, 37 to 31% is a bit alarming. 28 to 40%, yes, your GP margin has gone up. We need to say, we need to not just say it is gone up, why it has gone up. NP, net profit margin, has gone up. No, has come down, has come down. Your current ratio has gone up, looks positive. Quick ratio looks positive. Your inventory holding days probably has come down. You're selling more inventories. Your trade receivables collection period has come down, and your payable payment period has also come down. Your gearing has also come down. Not just that, but we need to connect it to the scenario. Our analysis has to be connected to the scenario. Now I'm going back to the scenario. I'm going to try and analyze the scenario one by one. Okay, guys, so far are we clear? Are we clear, everyone? Yes or no? I want everybody to respond. Are we clear so far? Super. Now let's try to understand this in depth. Okay, let's try to understand this in depth. During the year ended 31st March 2014, H had been subject to much press interest concerning its poor performance. It has been subject to much press interest. So there has been a lot of pressure because of its poor performance. The performance has come down. Company's performance has come down. Okay. The performance has come down. As a result, its share price had fallen considerably. Share price falling down is a problem. Probably your investors, shareholders are a bit concerned. So, 1, poor performance. 2, share price has fallen down, not just little but considerably. Keep that in mind. Okay. To remedy the situation, and help improve share price and market confidence. Share price about market confidence, guys. H employed Sparks. Sparks is a firm of strategic consultant. Okay, Spark is not a funny joker. They are a strategic consultant to recommend the best course of action to improve both its statement of profit or loss and statement of financial position. To recommend the best course of action to improve the P&L and the balance sheet. So coming back, when I'm coming here, look here, they say, write a report for the directors to assess the financial performance and position of H for the year ended 31st March compared to the previous year. Your answer should refer to the information above and the impact. Look at what your examiner, the word your examiner uses, right? Your examiner uses the word impact that Sparks has had during the year. So how has the strategic consultants had an impact in the current year's performance? Are we clear? Okay. The board of H worked quick. They were very, very quick to act on many of Spark's recommendations and are pleased with the effect that it has had on performance during the current year to 31st March 2015. And they are pleased. The board of Huston were quick. They immediately acted on the recommendations and they are very happy with the performance during the current year compared to last year. The draft financial statements are shown below. But you have revenue. Okay. When I see revenue, I can see revenue has dropped. Okay, revenue has dropped. So in the exam, if the revenue has dropped, I will immediately go and check what has happened to the overall profit. Revenue has dropped. I can clearly see from 10,000 to 9,600. However, the profits have gone up. So probably it looks like the consultant's approach would have been more than increasing revenue, but controlling cost. I mean, there are two ways to make a company profitable. By probably you can increase your revenue, you can have more profits, or decrease the cost, you will have more profits. So it looks like in the exam, I'm going to talk about, look, it's not about revenue generation approach, it's more about cost control approach. Okay, right. There you go. Like I told you, secondly, I can see the cost coming down. I can see the direct cost coming down. Are we clear? Direct cost coming down. That is, of course, increasing my GP margin. My GP margin is going up. That can be connected with this as well. So your GP margin from 28%, it is obviously going up because of your controls on direct cost. Because your direct cost has come down drastically. We do not know why. Probably we'll have to go and check why. But it's more of a cost control strategy than a revenue increase strategy. Okay? Are we clear? Guys, everybody, are we clear? Are we clear? Are we clear? Okay. My distribution cost is a bit alarming. It has gone up. I have to understand why. And my admin expenses have gone up as well. So I would expect my operating profits to slightly drop because these two have probably gone up by now. I know that. And I do see that as well. I have made a sale on my property for 200. And of course, my finance cost has come down. I need to see why. And I'm selling some plant. I don't know why. I'm keeping that in mind. So all those could have contributed to my profit. And of course, my taxation is coming down big time. My taxation is coming down. Okay. Overall, yes, the profit has gone up. More of a cost control approach, direct cost. But we'll have to see in detail what the notes say in the exam. We can't blindly jump into a conclusion. Okay. My property, plant and equipment has come down. Yes, that also speaks about the sale and the profit on sale of plant. That also speaks there, can be connected. Goodwill is still the same, and development cost, I've had double 120. So it looks like, I don't have development cost anymore. I don't know, probably my development was not successful. So probably I would have expensed it. That could be one of the reasons. That could be one of the reasons why my expenses here is going up. Could be. We'll have to go and check in detail. My share capital is still the same, but my retained earnings shooting up big time. Okay, I'm going for a loan. So probably I'm taking a loan this year. A convertible loan, and I'm also settling a loan. Okay, so I have to see from 2000 becoming 0. My deferred tax is coming down. Provision for overhaul. Okay, they are providing some overall expenses. Provision. IAS 37 is not permitted. So I believe there is a problem. Mistake with the accounting treatment. IAS 37 does not provide allow us to provide for overhaul. Overall is repair expenses of assets. It doesn't provide. Trade and other payables is coming down. My taxation is going up, and my bank overdraft from 1340, I have a positive bank overdraft. Okay, now if I have to go back and check what the ratios say. Ratios are also exactly reflecting this because obviously we've done it based on the financials, but we have to go and check what the additional information is talking about. During the current year, the development expenditure was written off. There you go. We guessed it right. Development expenditure was written off to admin expenses. That's the reason why admin is going up. The statement of P&L as the recognition criteria of IAS 38 were not met. So in line with IAS 38, basically it did not meet the criteria of IAS 38 intangible assets, capitalized development cost, technical feasibility, commercial viability, management intent, future cash flows. So all those conditions have to be satisfied. It did not satisfy. Because of that, what has happened? We wrote off the development cost to the to the in the current year we wrote off. So how much is it? Write off is about 1.1 million in development cost, which is obviously a major impact to our profits. Akash, I didn't understand what you want me to explain again, but there is a major impact in terms of 1120, which is included. So basically, if you see, technically our admin expenses has to be 1860 minus 1120, right? So 1860 minus 1120 should have been, but this has affected our financial statements. Overall provisions, overall, let me come back to that again in a bit. When I'm trying to work that out. Okay, let me not lose my flow. In addition, following on from one of the recommendations of Sparks, Huston is outsourcing the manufacturing of one of its products. Okay, there is an outsourcing happening. What you are doing is you are reducing your cost of sales, probably because you are not manufacturing anymore. That could be one of the reasons why your cost of sales is coming down. Are we clear? So one of the reasons why your cost of sales is coming down is because you are outsourcing. So probably, okay, here I can say cost of sales coming down. Here admin affected big time. Okay. There you go. This has enabled the companies to dispose some of the surplus plant. So because you are not using your plant, you are selling it. Okay, but it needed some repair, which was supposed to happen in 2015. Now that you have disposed, the repair is not happening. So therefore, what is happening? Your overall cost, your provision for overall cost 1480, which you provided for, is not there anymore. However, guys, try to understand this is not permitted. You can't provide for overall cost. Overall cost is not allowed. You can't take the overall cost into the financial statements and bring down the expenses. Not permitted. There is a problem there. Now did you understand? Now for me, I want to understand. Huston has been acquiring a provision for overall cost over a 4-year period, but due to disposal, this was no longer required and the provision was released to cost of sales. Meaning all these years you've been charging overall cost to your cost of sales, but this year you released it from your cost of sales. Because you released it, it looks like your cost of sales has come down drastically. That could be another reason for a drastic improvement in profits. Your treatment is obviously wrong, but yes. Are we clear? Are we clear? Okay. Can we start answering this? Let's start answering. That's my keyboard. So, well, ROCE has come down. ROCE has come down, which is a major problem to the shareholders. So let's give a little background to ROCE. In the current year, ROCE has dropped. ROCE is a primary shareholder ratio. Basically, you know, ROCE is one of the most important ratios. Okay. Okay. So in the current year, ROCE has dropped. ROCE is a primary shareholder ratio. Therefore, this is a bit alarming to the shareholders. But ROCE, when you take ROCE, it's a matter of your operating profits over your capital employed, correct? Like I told you. So coming back to our earlier argument, your ROCE is a matter of your operating profits and your capital employed. Your operating profits is your profitability element. Your capital employed is your how much of revenue are you generating through your asset turnover, right? So your operating profit and efficiency, it looks like your efficiency is dropping down based on what we can see, because your operating profit here, when I see, I think your operating profit is going up. I don't feel operating profit is dropping. Let me clarify it again. Your profits from, oh no, your profits from operations is coming down. Yeah, so that could be one of the reasons, right? So yeah, our gross profit is going up, so our operating profit is coming down. So there you go. Our ROCE can either be affected by our operating profits or our capital employed, but here it is being affected by a drop in the operating profit margin. So basically we can go forward and we can say it appears the operating profit margin has made an impact as this has reduced, and this has reduced. Okay, now you can of course talk why this has come down, because our admin expenses and distribution cost has gone up. In fact, the admin expenses and distribution expenses have increased due to it's gone up due to the development expenditure being written to the admin expenses. So due to development expenses charged to admin. Now, I'm not telling the examiner, look, it's gone up. I'm also giving a reason why it's going up. Are we clear? So in the exam, you need to make sure that you tell the examiner, hey, look, this is going up. Correct. But why is it going up? It's a bit of an analysis. It's a bit of a problem to the shareholders, yes. But I have to tell why it is a problem. Are we clear? Now, next, GP margin is going up. We know our revenue has dropped, but we know there have been better control in terms of cost. So, GP margin, GP margin has achieved a growth in the current year. This is due to due to uh, due to better cost control than increase in revenue. Obviously, right? You know, when you say itself, your revenue has not increased, but your cost control is really, really, really good. So we're going to talk about that, right? So that is one point that we can talk about. The second point, what else can we talk about? Guys, go on. What else can we talk about here? Why do you think this has achieved? This happened? Why? Why? Why do you think this happened? Why? Outsourcing. Well done, Shahadia. You've made an outsourcing decision. So your cost probably has come down because you've outsourced. Now look here. There you go. They say, following one of the recommendation of Sparks, HCO is outsourcing the manufacturing of one of its products. So probably that could be one reason there where your direct cost is coming down. This is due to outsourcing uh, one of the products manufactured in-house earlier. Outsourcing one of the products previously manufactured in-house. Okay. No, I don't think development cost is added to cost of sales. They say development cost is taken to admin expenses. So I don't buy that. I don't buy that. I don't buy that. But is there anything else that is affecting? Guys, go look for it. Is there anything else that is affecting? Well done, Abdullah. Others. What else? What else? Well done. Overall provision releasing. Okay. Overall expenses, that is a wrong treatment anyway. Further, in the current year, the overall was released, and this has also contributed significantly to the increase in GP margin. The treatment is incorrect in line with IAS 37. That is wrong. Are we clear? Are we clear, guys? Okay. Now let's try to understand. Let's try to understand it further. Last year you had this 1480, no guys. Last year you had this 1480, meaning this 1480 was included here, 7200. Now let's try to add this 1480 or 1400. 1480. Let's try to add this 1480 to this. So that is 2800 plus 1480 gives you how much? 4280. 4280 says Akash. So basically, this is a major contributor. So if you actually look at it, your GP margin would have been lower than last year. If you actually look at it now. Let's say in simple terms, last year this can't be there, correct? So last year's GP margin would have been how much then? 4280 over 10,000 gives you how much? 42%. This year 40%. Do you understand? This year 40%. So in reality, if that was not there, if the error was not made, the GP margin would have been dropped this year. In fact, a closer look will reveal that the GP margin would have dropped in 2014 if the overhaul cost is reversed in 2015, if the overall cost is reversed in the 2014 financials. Guys, do you understand? Yes or no? Guys, do you understand that point? It's a very important point. You need to be able to understand in the exam. Are we clear with that? Yes or no? Everybody, are we clear with that? You understand what I'm trying to say there, guys? Everybody, are we clear there? Everybody, are we clear there? Okay. Super. Now let's come back to net profit margin, right? Now when you're trying to take your net profit margin here, you're taking your PBT, profit before tax, and here in fact is dropping down. And obviously we know major contributors for dropping down, although yes, there is a plant being sold. Okay, your major contributors to this is the development cost, obviously, and your distribution cost has gone up big time. Why do you think your distribution cost would have gone up? Shadia, why do you think your distribution cost would have gone up in the current year? There is a slight drop in the net profit margin. This is primarily contributed to the increase in indirect expenses, cost due to development cost, cost due to development cost, and there is an increase. In terms of what? There's an increase in terms of what? Distribution cost. Why do you think there's an increase? Because you're outsourcing. Your distribution cost can go up. You should be able to conclude like that. And development cost and distribution cost, which has rose significantly due to outsourcing. Don't you see? Are you clear? Are we clear? Everyone, are we clear? Guys, you understand? Are we clear? Everyone? Are we clear? Everybody, I want everybody to respond. Guys, our liquidity and obviously quick ratio has slightly increased. So I can maybe put together and I can speak about how our liquidity has impacted. So let me also go and check how my bank balance is like. Okay, my bank balance from an overdraft is about 840, looks a bit positive. So let me try to get that connected, right? Not a major improvement, but it's very slight improvement between quick and current ratio. Current and quick ratios have slightly improved compared to the previous years. However, guys, when you look at quick ratio, it is below the acceptable one benchmark that we have. However, the quick ratio is still below the accepted benchmark. Okay, how do we have a positive cash balance? Why do you think we have a positive cash balance this year? Why? Of course, our trade receivables have come down, our inventories come down, but there you go, Shadia. Well done. Well done, Shadia. Brilliant. We've sold our plant, so that can also have an impact on our cash. In the current year, cash flows looks positive compared to an overdraft last year. Okay. This perhaps was contributed heavily through the sale of the plant. Okay, for cash flows to be more sustainable, operations should generate cash flows. Sale of long-term assets could also be an indicator of going concern issues. Are you clear? I'm just trying to bring both together and show it in one listing. That's okay, no problem. You can bring it together. Okay, wherever you can connect, it's still fine, not a problem. Our inventory holding period has come down big time. It has come down big time. I believe it's because of outsourcing. We are not holding inventory, and probably we are trying to bring in just-in-time system where you need it, we give it. Yeah. So the problem with that probably could be, okay, stock outs. I need to make sure that there is I'm not running out of stocks. So inventory holding period has dropped significantly. This could obviously save in terms of space and rental cost. This could save up on space cost for sure. The reason for this increase could be due to outsourcing. However, if adopting just-in-time system or uh, just-in-time system or holding less inventory. H must ensure there's no stockouts. Are you clear? Are you clear? Superb. Uh, Trade receivable days coming down. Trade receivable days overall coming down. Looks positive. The reason, we need to understand why. The reason could be probably we are doing a debt factoring. Could be due to debt factoring. So debt factoring, still sometimes you have factoring with recourse, without recourse. I'm sure you would have covered when when doing your syllabus. Debt factoring probably can result in risk if you don't pass it to the other party, clearing agency. But we have to see what is the basis of this. This could be due to debt factoring. However, better credit control system can be implemented to ensure trade receivables are properly monitored and managed. Your payable periods is going up from it's coming down once again from 138 to 106 days. Obviously you are paying faster, so better goodwill, maybe more discounts, but your cash flows are coming down. Without proper cash flows, you can't make this decision of paying quicker. So you need to make sure that you talk about that. Trade payables is coming down. Obviously improves supplier goodwill and also more discounts. However, without sustainable, where do you want to connect? Sustainable bank balance, probably yes. However, without sustainable cash flows, care must be taken when managing cash flows. Finally, we have gearing. 42 to 32%. There's been a 10% decrease, lowering business risk, not just business risk, also your interest payments. Initially, you had 12% loan note, but now you have 10%, 8%. Looks like it's a good strategy. From 12 to 8%, your finance cost is coming down with equity conversion. Now you move to an equity conversion rather than a loan, a liability. So low interest rate, low risk. So, but however, with conversion, your EPS can be affected. It could dilute your earnings per share. So EPS should be calculated to inform your shareholders. So yes, gearing has come down and looks a good strategy from moving to 8% loan to moving to 8% convertibles from 12% loan, therefore reducing financial risk and financial cost. Okay. However, convertibles will impact EPS, earnings per share, and this to be calculated to notice shareholders or investors. Okay, with that I can give a slight conclusion in the exam. A slight conclusion would do, no problem. It appears Spark's recommendation did show some improvements to the financials, as liquidity and GP has slightly changed. However, immediate action must be made to improve revenue and better control cost and liquidity. Okay, for the analysis to be more conclusive, we need further evidence, further information, such as number one, past financial statements, number two, budgets and forecasts. That's okay if it's forex in the exam, that's fine. If you say forex, I know there's a mistake, but that's okay, your examiner wouldn't mind it, no problem. Number three, competitor analysis, what's happening the competitor within the competitors and external environment. I want to understand that. Number four, any political pestle analysis, what is that? Pestle, spot, external internal analysis, and any other relevant information. There you go. That's how I get my 20 marks in the exam. I know for this 20 marks, you can spend approximately 20 into 1.8, about 36, I'll say about 40 to 42 marks. But don't panic in the exam. Try to see wherever you can work around, connect, and try to answer the questions. Can we mention about the error? I did mention the error somewhere here, so let's not repeat it. Don't have too many repetitions. Just speak about points. That's enough. You will get your answers. You'll get your marks. Are we clear, everyone? Are we clear, everyone? Are we clear? So I'm trying to share this with you. Okay, FR marathon. Okay, so there you go. I'm trying to share it with you, so it should be here. Tomorrow, once again, I'm going to meet you at 6:30. But let me ask you, do you want to do another question on ratios, or can I start off with consolidation tomorrow? Consolidation, one cash flow question I've taken, consolidation. Okay, let me see if I can do another ratio question. Let me try. If time permits, definitely yes. But tomorrow, let's start off with consolidation. I'm going to show you how to get your consolidation right. Coming back, consolidation is not one. It is one of the major area in your syllabus. It is tested. It will be tested. It can be tested for minimum 15 marks, maximum to about 20 marks. It will be tested in every exam session. And there you go. It can come in any part of the syllabus. IFRS 10 covers consolidation. Consolidation is about bringing together two or more companies and bringing together and preparing one set of consolidated financial statements. That is consolidation. Now guys, when you take consolidation, one of the primary areas that I want you to know is bringing two entities together in terms of consolidated financial statements, consolidated income statement. That is one area. And also there is associate that can be tested. So you need to know consolidated income statement and balance sheet. That is one area covered by IFRS 10, and then IAS 28 covers investment in associates. Okay, so basically what you need to do is you need to be able to work on income statement, work on balance sheet. Sir, can you work out the pyramid sum? No problem, but I think pyramid is only balance sheet. So as a starting point, what I will do is I'll do where you have income statement and balance sheet, and then maybe as another alternative I can do pyramid during our marathon session itself. No problem there. Super. Because I want to have already picked a question which is going to cover both income statement and balance sheet. First way to get that background, and then we'll try to work on a question that you give me as well. No problem, that's fine. So and then I want to do a question which can obviously cover IAS 28 investment in associate as well, so that I'm covering I'm trying to cover everything given this minimal time period that we have. Okay, so with consolidation, some of you who have been with me, you know the shortcut, the steps that I use. So I'm going to quickly take you through the steps once again, so that the ones who are new for our session are also in par with what they have to do. Brilliant. So when it comes to consolidation, guys, I'm going to give you some shortcuts, right? And I want you to make sure that you are in line with these shortcuts, because this is definitely going to help you for your exams, right? Okay, super. Now let's look at the shortcuts. It's very simple. Give me a moment, I'm getting some messages. So I'm finding it difficult to join. Okay, well, that's okay. Right, we are good to go. Okay, guys, in the exam, what I want you to do is I want you to leave about 40-50 lines. In the exam, I'm going to show you how exactly you have to work around the question, but let me show you. Right, first of all, consolidation shortcuts. These are the things that you need to keep in mind when you are doing a consolidation question. Okay, super. Step number one, always draw the group structure. You need to understand the group structure. You need to know who is acquiring whom. Parent, subsidiary, associate. You need to know the relationship with NCI. Step number two, I want you to take the reserves. When I say reserves here, I'm talking about retained earnings and revaluation reserves, retained earnings and revaluation reserves at balance sheet date. Now guys, this is where most of the students go wrong. You have to take it at balance sheet date. Retained earnings and revaluation reserves as at the balance sheet date. Balance sheet date means year end date. So that is very, very, very crucial. I want you to make sure that you don't mess up there. Step number three. Step number three. You are going to go to the top at assets, and liabilities. Now, when you add assets and liabilities, you have to leave space. You have to leave space because this we are going to work this a bit later. You have to leave space for goodwill on acquisition. You have to leave space for investment in associate. Okay, you have to leave space for goodwill on acquisition. You have to leave space for investment in associate. Don't worry, I'll do a question with you today itself. Leave space for consolidated retained earnings. Number 4, consolidated revaluation reserves. Number 5, non-controlling interest, NCI. So you're going to leave space for all this on top when you are doing the line by line addition. Once you're done there, step number 4. Your examiner will give you some notes. Now those notes will be adjusted, so it becomes adjustments. So from notes it will become adjustments, notes to adjustments. Okay. Now you need to know few things. What are the common adjustments that can be tested for you? Number 1, intergroup transactions. Any transactions between the parent and subsidiary. Parent can sell goods to subsidiary, or subsidiary can sell goods to the parent, has to be eliminated. Any transaction. Any loans between the parent and subsidiary has to be eliminated. Dividends, interest payments, finance costs, all those are going to be eliminated. So very important, you are going to eliminate loans, dividends, interest between transactions between the parent and subsidiary has to be eliminated. So point number 1 below that, any intragroup transactions between parent and subsidiary will be eliminated. For example, loans, transactions, dividends, interest, etc. Are we clear? Okay, that's the first thing to keep in mind. Second thing, you will have adjustments for intergroup transactions. You will have something called items in transit. Items in transit means one party has sent goods or cash, the other party has not received it. So basically you have to put up a little equation. You're going to put up a little equation and you're going to eliminate this. What is the equation? Intergroup trade receivables minus cash in transit. Yeah. Cash in transit minus goods in transit gives you intergroup trade payable. So you're gonna less this in the equation, less this in the equation. But when you're going to take it to the financial statements, this is going to be eliminated from trade receivables, meaning deducted. This is also eliminated. This is added, and this is added. The financial statements, that's how it will be. Consolidated financial statements, that's how it will be adjusted. Guys, keep in mind. And next point, fair value adjustments. There can be fair value adjustments like revaluation. So you got to make sure that you account for it. Next, fixed asset transfers will also be eliminated. The parent would have transferred fixed assets to subsidiary, or subsidiary would have transferred, it has to be eliminated. If there's any additional depreciation, that should also be accounted for. Are we clear so far? And then of course you can have realized profits. This is normally tested in every exam session. 1, 2, 3, 4, 5. Or your examiner can connect you, or your examiner can connect this to a scenario, to a standard. So connection to an accounting standard is also possible. Now you need to know step number one, always put up the group structure first. Step number 2, reserves at the balance sheet date, very, very important. Step number 3, add assets and liabilities, leaving space for all this. And number 4, adjustments. But when you do these adjustments, it can get connected to an accounting standard like I just told you, or very, very, very important, everything at goodwill, everything at acquisition must be noted. So you are going to note everything at acquisition has to be noted separately, so that you can adjust when calculating goodwill, because goodwill will be affected with any adjustments to at acquisition. Whatever is happening at acquisition will have an impact on the goodwill figure. Now that is done. 6, number 7, very straightforward. Calculate consolidated retained earnings, NCI share of net assets, NCI share of net assets, consolidated revaluation reserves, anything else? That's it. There you go. So like I told you, retained earnings at acquisition, adjustments at acquisition is very, 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 very important. Are we clear so far? Yes or no? Are we clear so far? Yes or no? Everyone? Are we clear? Are we clear? Okay. Now, what I'm going to do is I'm going to do a question with you. While doing the question, I'm going to explain the adjustments, possible adjustments that can be tested for you in the exam. Okay. Brilliant. Well, like I told you, I have picked a question which has both income statement and balance sheet. So Polestar is a question which has both income statement and balance sheet. I'm going to start off with this question. So consolidated income statement also I can cover, consolidated balance sheet also I can cover. Okay. But before we start, your revision kit itself says, note that the level of work required to answer this question is beyond that to be expected within the current exams. Okay, your current exams, you're not going to get something at this level. You're not going to get. Okay, because this is going to be a bit too much for the level right now. However, it provides a proper revision before the exams. So it provides a useful revision exercise as it tests both statement of P&L and statement of financial position. Something detailed as this will not be tested in the exam, but it's okay for us to understand tiny areas in a deep manner so that we are prepared for the exams. When you go to the requirement says, prepare the consolidated statement of P&L for Polestar for the year ended 30th September 2013 and prepare the consolidated statement of financial position for Polestar as at 30th September 2013. Okay, now what I want you to do is very simply, forgetting everything, take it easy. All what I want you to do is, you come here, in the exam, you're going to have something like this, right? You will be having something like this. So I got stuck in this question, sir. Good that you picked this question. Okay, you got stuck in this question. Brilliant. Okay, don't worry. Hopefully we can figure it out together. Okay. Brilliant. So in the exam, you are in the examination hall, you have a question like this, income statement and balance sheet put together, it's going to be a lot. You need a lot more space. So I want you to leave at least about 50 to 60 lines. You come here, right to the bottom, and always, 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 you need to remember to go back to the shortcut, what I have asked you to look into. Now, first thing I say, always draw the group structure. Okay, now first thing would be your workings. When you come here, working number one, group structure. Working number one is group structure, meaning who has acquired whom. Okay, before that, before I take you through the entire question with me, like yesterday, I want you to read the question on your own. I want you to read the question on your own and understand few things so that we can work around it together. Okay, I'm going to give you about 5 minutes to go through the question on your own. Okay, start. In between, fill some water for me. In the exam, you have to be quick in going through the question. Okay. Guys, can we? Are you done? Are you done, everyone? Can I? Okay, brilliant. Now, guys, in the exam, you know what is required from you. What is required from you? You know the steps that I've given you. I want you to be in line with the steps. That's enough, more than enough. Okay. Based on the steps, the very first thing that you have to identify, based on the steps, the very first thing that you need to identify is the group structure. Okay, let's go back. Let's say on 1st April 2013. Okay, one thing in the exam, very important thing, your dates. 1st April 2013, immediately you see that you come here 30th September 2013. Okay, on 1st April 2013, Polestar acquired 75% of Southstar. Polestar parent acquiring 75% of Southstar. When this is happening? On 1st of April 2013. Okay, listen to me very carefully. Your year end is 30th September. In other words, let's put up a little graph, a little not a graph actually, a little timeline. Your year end is 30th September 2014, correct? 30th September 2013, I'm sorry. So basically 2013, you would have started from 1st of October 2012, correct? 1 year, no? Are we clear there? 1 year, no? So from 1st of October 2012 to 30th of September 2013. But the company was acquired when you're acquiring the company on 1st of April 2013, meaning during the current year, Polestar is acquiring Southstar. So when is that happening? If you technically see, that is happening here. 1st of April 2013. Are we clear? So during the current year, the acquisition is taking place. Guys, if the parent, point to know, if the parent acquires a subsidiary during the current year, like this in this case, during the current year, if the parent acquires a subsidiary, we call it a mid-year acquisition. A mid-year acquisition. If it's a mid-year acquisition, very importantly, you have to keep in mind all incomes and expenses of subsidiary will be time apportioned. Time apportioned for 6 months, meaning only from this point onwards, all the income and expenses will be given to the subsidiary. Subsidiary's results will be consolidated to the parent in the income statement. Balance sheet, you don't have to worry anything because as at that point, everything belongs to the parent. Are we clear, everybody? Did you understand that? Yes or no? Did you understand that? Yes or no? Everyone. Keep responding. Take it easy. Super. Now, let's go to the top. Polestar acquired 75% of Southstar. Southstar has been experiencing difficult trading conditions, tough conditions, that's okay, and making significant losses. In allowing for Southstar's difficulties, Polestar made an immediate cash payment of only 1.5 per share. Okay, now coming back, IFRS 3. IFRS 3 is applicable for goodwill calculation. IFRS 3 says, business combinations device says, if a parent is going to acquire a subsidiary, the parent can only make payments in 3 mediums, in 3 modules. What are the 3 modules? Number 1, immediate cash payment. You immediately pay cash. Number 2, deferred payment. Deferred payment means you don't pay cash immediately. You come to an agreement. You say the owners of subsidiary, okay, I'll pay in 1 year's time, 2 years time, 3 years time. Therefore, if you are going to agree in 2 years time or 3 years time, you have to calculate your present value. Right now, what is the value? Your present value equals future value over 1 plus r to the power n. That's the second thing. On number 3, what you have to do is you can go for a security exchange. A security exchange is a loan note exchange, or you can go for a share exchange. You give shares and you take shares. Yeah. Are we clear? Are we clear? Now, in this case, guys, what is happening? In allowing for South Star's difficulties, Polestar made an immediate cash payment. You are making an immediate cash payment of only 1.5 per share. In addition, Polestar will pay a further amount in cash on 30th September 2014. You are acquiring on 1st of April. So you are going to pay on 30th September 2014. If South Star returns to profitability, that is only if subsidiary returns to profit by that date. Now, let's say even if you know that it's not going to become profitable, it's okay. Right now, IFRS 3 says you have to recognize. No matter what happens, that doesn't affect you. It doesn't make profits, it doesn't affect you. You are going to recognize it today. Are we clear? Brilliant. The fair value of this contingent consideration, because you are going to delay the payment, you call it as a contingent consideration. At the date of acquisition was estimated to be 1.8 million. Now, when you acquired, you thought you are going to pay 1.8 million. They are giving you the fair value, meaning the present value is already calculated. You don't have to do anything. But at 30th September 2013, guys, as at this point, year end, the contingent at 30th September 2013, in the light of continuing losses, the value was estimated at 1.5 million. You thought you're going to pay 1.8 million, but what's happening as you go on after the year end, you see, okay, no, it's not worth it for 1.8 million. I'm going to pay only 1.5 million. You thought you're going to pay more, so you recognize more, but your liability is coming down. A reduction in liability. In other words, you have a reduction in liability. What is a reduction in liability? A reduction in liability is an income or an expense. A reduction in liability is an income or an expense. A reduction in liability is an income or an expense. It's an income. It's an income. An increase in liability is an expense. A reduction in liability is going to be an income. So you will have an income. Okay. Overall, directors of Polestar expect the acquisition to be a bargain purchase, leading to negative goodwill. Now, what is goodwill? Goodwill is the premium paid. You have the net assets. On the value of the net assets, when you pay a premium, something extra, it becomes goodwill, positive goodwill. But let's say you have, I have this keyboard, right? I have this keyboard, right? Or net assets, whatever. I have net assets. On the net assets, I pay a lesser amount. When I pay a higher amount, it is goodwill, a premium. When I pay a lesser amount, it is negative goodwill. Meaning it's not technically a premium paid. In other words, I bought the company at a discount. If I buy the company at a discount, we call it, it's a bargain purchase. I'm bargaining my purchase. IFRS 3 says, listen to me very carefully, IFRS 3 says, if it's positive goodwill, to show in the financial statement. If it's negative goodwill, you do not show in the financial statement. However, you will calculate it. Now, here they say it could be negative goodwill, but you have to calculate. Okay, it's not, you can't be in a position where, okay, you say, no, I'm not going to show it in the financial statements. I'm not going to show, I'm not going to calculate it. No. You have to calculate it. Since it's a bargain purchase, it becomes an income. It becomes an income. It becomes a gain. This gain is added to retained earnings. Are we clear? Are we clear? Are we clear? Okay. Now these are for explanation purposes. Okay. Akash, it's a gain. Because it is a gain, the value is 100,000, but I buy it for 80,000, means I make a 20,000 profit. No, Akash. This 20,000 profit is a gain, therefore I add it to retained earnings. It's an income. I'm going to show it to you as we do this calculation. Okay, like I told you earlier, look here. Here, in this case, in the exam. Now, guys, those are my explanation. Okay, this is how I want you to approach in the exam. Okay. Now always draw the group structure. I want the group structure. That's where I am. Now tell me, based on this, what is the group structure like? Polestar is acquiring Southstar 75%. So in the exam, I'll say Polestar acquires 75% of Southstar. Polestar is the parent, Southstar is the subsidiary, and then you have 25% NCI. I got my group structure done. Also, you need to mention it's a mid-year acquisition. This is for your reference only. Okay. Done. What is my second step? My second step is reserves. I need reserves, retained earnings. Whose retained earnings? Both parent and subsidiaries, both. So I come here, working 1 done, working 2, reserves. Working 2 is my reserves. So I come here, I'll say I need Polestar's reserves, I'll need Southstar's reserves, both. So both in terms of what? In terms of retained earnings, I need also revaluation reserves. I need both. Okay, I told you I need reserves at balance sheet date. Always, always, always. Make sure you get it at balance sheet date. So guys, don't miss that. This has to be at balance sheet date. Are we clear? At balance sheet date. Are we clear? Are we clear? Are we clear? At balance sheet date. So I come here, I need retained earnings at balance sheet date. So I will go to the question. Now here is the question. Now here, your balance sheet date is when? Your balance sheet date, guys, is 30th September 2013. Therefore, I have 28,500, 12,000. Are we clear? Sometimes your examiner can have the opening retained earnings plus current year profit. Your examiner can do that. In that case, you need to add and take the total. Okay, you need to add and take the total. Now, in this case, 28,500 from balance sheet, 28,500 and 12,000. And then, do you have any revaluation? You don't have any revaluation, therefore your revaluation is going to be 0. Guys, are we clear? Understood? Yes or no? Are we clear? Understood? Yes or no? Brilliant. Let's go further. Always, always, always my steps. So step number 1 done. Step number 2 done. I'm moving on to step number 3, which is adding assets and liabilities. But when I add, I'm going to leave space. I'm going to leave space and I'm going to add, take my assets and liabilities. Clear? Okay, brilliant. So let's go back. In the exam, it will look like this. There you go. I can go to the top. I can start with balance sheet and do the income statement, or you can start with the income statement and the balance sheet, no problem when it comes to consolidation. So I'm going to say Polestar's statement of financial position as that 30th September 2013. Okay. Now I'm going to add my assets and liabilities from here. In the exam, you have the option, the privilege of copy paste. You can copy paste, but here I'm just going to simply take it from there. So I'm going to take assets, non-current assets. Please don't take any shortcuts here. Please don't say NCA. Please take the entire full form here. But in your workings, you can have your shortcuts, no problem. So you can have your property, plant and equipment, and then you have your investments. Your investments will result in goodwill on acquisition. Remember, I asked you to leave space for goodwill, and then I also ask you to leave space for investment in associate. Now if you look here, leave space for goodwill, leave space for associate. Now I come back here, my property, plant and equipment equals 41,000 plus 21,000. There you go. My investment value is equals 13,500. My goodwill, I have not calculated it, so I'm going to leave it empty. My investment in associate, I have not calculated it, I'm going to leave it empty. And then I'm moving on, my current assets. When you take my current assets, I have equals 19,000 plus 4,800. Therefore, my total assets is this. Are we clear? Are we clear? Okay. Next, I have my equity and liabilities. Under equity and liability, I have my equity shares. My equity shares, guys, in the exam, always, please take your parents. Don't take subsidiaries. Always parents. And then you're going to leave space for consolidated retained earnings, consolidated revaluation reserves. You're going to leave space for NCI share of net assets. These are things that you have to leave space for, like I told you here. Please make sure you leave space for them. Then you move on. You can take your non-current liabilities, no non-current liabilities. So current liabilities, so you can take your current liabilities, and that is equals 15,000 plus 7,800. There you go. That's your total assets. This is your total equity and liabilities. Now that is done, and then you go back and statement of P&L. So Polestar group of companies, consolidated statement of profit or loss for the year ended. Our year end is 30th September 2030. There you go. And below that, I've got my statement of profit or loss. There you go. That's done. So I have my revenue. That's done. I have my revenue. That's right, Nivedita. That's right. So I have my subsidiary for 6 months equals 110,000 plus open brackets. Be very careful. Into 66,000 into 6 over 12, 143,000. Next, I have cost of sales. This is my cost of sales equals 88,000 plus open brackets 67,200 into 6 over 12 into 6 over 12. Make sure you do that. Okay. Next, gross profits equals this minus this 21,400, and then you have your operating expenses. Your operating expenses are equals 8,500 plus open brackets 4,400 into 6 over 12. Next, profit before tax. We have our profit before tax, and then we have our taxes. I've taken the operating expenses, right? Profit before tax, and then I have my taxes. So if you take our taxes, equals, so it's a minus 3,500 plus 1,000 into 6 over 12. So minus 3,500 plus it's 500. So minus 3,000, and therefore I have my profit after. Are we clear? Are we clear? Guys, everybody, are we clear? Yes or no? Brilliant. Now guys, okay, you have to be very, very, very careful. Now you're here, your workings are done. Come back to your steps. You need to know the steps. Now I'm working myself with the steps. Step number 4, my adjustments. Adjustments means everything that I have to adjust from the financials that I've been given. Now here I'm going to start working on my adjustments. So let's start off. Whatever I require from here, I'm going to plug it here. So working number 2 done. Working number 3. Here they say on 1st April 2013, Polestar acquired 75%. That's done. So S has been experiencing difficult trading conditions. No problem, done. Making significant losses. In allowing for such difficulties, Polestar made an immediate cash payment. So your investment cost. So your investment cost, you've got immediate cash payment. They say immediate cash payment is 1.5 per share acquired. So they say clearly here, they are paying 1.5 per share acquired. 1.5 per share acquired. Correct? So that's going to be my investment cost, right? So how will I calculate that? In total, my subsidiary has how many shares? 6,000 shares. So equals, in the exam, equals 6,000 shares. 75% I'm acquiring. For every share that I'm acquiring, I'm paying 1.5. So, there you go. So that's 6,750. Correct. Okay, hold on. There you go. Equity shares 50 cents per share. So therefore, yeah, good one, guys. Good one. Brilliant. So total number of shares would be 6,000 divided by 0.5, 12,000 shares in total. Okay, good one. Superb. Well done. Take it easy. Screen is blurred. Is my screen blurred, guys? Is my screen blurred? Probably there's a lot of rain in here, so probably because of that. But others, my screen is blurred. Oh, what do I do? I have connected myself to the faster. The PDF is unclear. Okay. Now, any better? Now, any better? Others, everyone? Now the Excel sheet is unclear. Okay, let me try to get a balance now. Life is difficult sometimes, isn't it? Let me check. Yeah, it's a bit unclear. Excel sheet is unclear. Okay, I'm trying to have a look at it. Okay, is it the internet that is the problem or? Just a moment. There's any luck now? Does it work? Guys, is it clear now? Can you hear me? Manageable. Do you see my screen now, everyone? Better? And superb. Probably because the weather is very bad in here. Even now, it's not great, huh? Better than before, right? This way better now. Okay. Thanks. Okay. Right. Sorry for the inconvenience. Yeah. This is part and parcel of life. These are uncontrollable factors, right? But guys, basically, you also should understand it works both ways. My internet connection has to be also strong. Your internet connection has to be also strong for you to get the output, the better output, right? Okay. Anyway, so 12,000 shares we have in total. So we know here you're paying 1.5 per share acquired. So therefore, your acquiring equals 12,000 into 75% into 1.5 per share acquired, 13,500 in total. Everybody got it? Everybody, you're getting it? Yes or no? 13,500 in total, guys. Okay. You debit investment cost. You're paying cash, so you credit cash. So technically, you have to debit investment cost. Your examiner is saying here, look at this. The fair value, it's also okay. The fair value of this consideration, wait. Okay, the contingent consideration, your examiner clearly says, okay, the contingent consideration has not been recorded by Polestar. So meaning your cash payment has been recorded. Your immediate cash payment has been recorded, and it is also reflected when you see here. It also shows here 30,500 here. When you come here, it is recorded. So you don't have to do anything there. So you can just take it because it is relevant for a goodwill. Okay. Second, number 2, you have a deferred payment. They say the deferred payment is 1,800. Again, well, you thought your present value was 1,800, but year end the value you have has come down to 1,500, meaning a 300 decrease. A decrease in liability of 300 is obviously a gain. So guys, look here. They say the contingent consideration has not been recorded. So obviously what you are going to do is, number 1, you have to go and record this. Okay, so first and foremost, what I'm going to do is I'm going to go and record this my contingent consideration, right? So I have 1,800. So basically I have to make this contingent consideration of how much? 1,800, meaning I have to debit my investment cost. I have to pay this, so I have to credit my liability. So I'm going to credit my liability as well. So I come here, I'm going to say go to my liability plus 1,800. But as at the year end, what is actually happening? The liability is reducing. Am I right, guys? Whatever I have to pay is coming Down. Now that my liability is coming down, it is a gain, it is an income. Therefore, I have to account an income as well. So two things, a gain on deferred liability and my liability is coming down. So how much is my gain? I come here, 300 is my gain. So I come all over here. My retained earnings gain on deferred liability. How much is the gain? I make a gain of 300. I'm going to put here. My liability is reducing. So I come over here. 24,600 minus 300. Are we clear? Yes or no? Are we clear, everyone? Yes or no? Everybody. Are we clear? Yes or no? No. Okay, I've got to know. So I'm going to explain it again. Okay, Shahtia, you with me? Okay, brilliant. Shahtia, basically what is happening here? Here, do you understand that I had to pay 1.8 million? Now I'm paying only 1.5 million. I had to pay 1.8 million. Now I'm going to pay 1.5 million. Correct? Correct, yes or no? Now I have to account for my 1.8 million. No, that is my 1.8 million here, 1,800. But year end has come down. So my recognition itself has not been done. So I'm going to immediately recognize because I have not recorded my contingent consideration. How will I record? I will debit my investment cost 1,800 and I have a liability to pay. No, so I will credit my liability. I have 1,800. That did you understand? Yes or no? That did you understand? Yes or no? Yes, you understood that. Abdullah, you understood that? Yes or no? Now there is a reduction in liability. No, I thought I'm going to pay 1,800, but now I'm going to pay only 1,500, meaning 300 a reduction. This 300 becomes a gain for me. No, so that gain I have to add it to my retained earnings. No, there you go, retained earnings 300. And my liability is reducing. No, I credit my retained earnings, increase my retained earnings. My liability is reducing. So I remove it from my retained liabilities minus 300. So technically I have to pay only 1,500. Now clear? Got it. Super. Now guys, entirely I've covered this point. Entirely done. Entirely this point is covered. Nothing to worry. So let's go further. We come here, steps, always steps, and on top we are done. Step 3 done. Step 4, I'm going to do my adjustments. Adjustments, my intergroup transactions, items in transit, unrealized profits, fair value adjustments, fixed asset transfer, connection. There can be something connected to an accounting standard, whatever. But when I do it, everything at acquisition must be noted. I'm going to write down separately. Okay, I'll tell you how to do it. At the date of acquisition, in the exam, this is a very important point. At the date of acquisition, the term acquisition at the date of acquisition means relevant for our goodwill calculation. At the date of acquisition, the fair values of Southstar's assets were equal to their carrying amounts, with the exception of a property. So all the net assets, when you acquired, when you did a fair value calculation, everything was okay, no problem, but except for a property. This property had a fair value of 2 million above its carrying amount. Now the value has gone up by 2 million of the property. Okay. Above the carrying amount. Stop there. 2 million above the carrying amount means what? There is a revaluation gain. So basically you have to account for the revaluation gain. So let's go back. Polestar. Next point, working number 4. Working number 4. Revaluation gain. How much is the revaluation gain? The revaluation gain is going to be 2 million. So revalue property, plant and equipment by 2 million. How do you do that? You come to the top. There you go. There is revaluation reserves. That's the reason why we put this up very early. There is a gain of how much? 2000. I go to the top. My property, plant and equipment should go up by 2000 plus 2000. Understood? Yes or no, guys? Did you understand that? Yes or no? Guys, did you understand that? Yes or no? Very simple adjustments, guys. Don't complicate things, okay? And had a remaining useful life of 10 years at that date. So you had 10 years remaining useful life. So basically this revaluation is not captured, no. Because this revaluation is not captured, the depreciation is also not captured. But like I told you, one thing that you need to keep in mind is here, when is this happening? This is happening at acquisition. Therefore, this particular revaluation, you need to mention A at AQ. At AQ means this becomes relevant for my goodwill calculation. Okay, keep that in mind. We go forward, meaning I'll be using that later. W5, you have depreciation. They say remaining useful life of 10 years at the date of acquisition and all depreciation is included to cost of sales. So this 2000 which you have was not depreciated. So 2000 over 10 into you are acquiring it for 6 over 12 months. It's been acquired. So since the date of acquisition, 2000 over 10 into 6 over 12 gives you 100. Gives you 100. Are we clear? So 100 is the depreciation which has to be deducted from our retained earnings. So I come to the top, I go here, I will say depreciation minus 100. And I go to the top from my property, plant and equipment. Obviously, I have to account for depreciation minus 100. Understood? Yes or no? Understood? Yes or no? Guys, only revaluation will be affecting our goodwill calculation. Depreciation won't affect. You know why? Because depreciation affects post acquisition. So everything at acquisition is relevant for our goodwill calculation. Working number 6. Polestar transferred raw materials. Okay, obviously there is an intergroup transaction. So intra-group transaction. So what is happening? Polestar transferred raw materials, listen to me, at their cost of 4 million to Southstar in June 2013. During the year, Polestar is transferring to Southstar. So P parent sells to subsidiary. How much are they selling? The value is 4,000. Southstar processed. So they processed all the materials, incurring additional cost of 1.4 million. They're incurring a cost of 1.4 million in total, and they have the material with them and sold them back to Polestar. So one, Polestar is selling to Southstar, and then two, Southstar subsidiary is selling to Polestar. So there are two things. Parent selling to subsidiary selling to the parent. How much are they selling it for? 9,000. Therefore, sales of both between the parent and subsidiary in total will be 13,000. Any intergroup transaction will be eliminated. So there you go, eliminated. Are we clear? Okay, guys. One thing I think we actually forgot about the income statement. So I have missed out the adjustments to income statement. So I'm gonna work the income statement adjustment as well. So basically we have to do it together. Okay. So we were focused on the balance sheet. We forgot the income statement. So I'm going to show it to you right now itself how to adjust. Now look here. Okay. Before going there, did you understand this particular element? Yes or no, everyone? Did you understand this? Yes or no? This 13,000, did you understand? Yes or no? Everybody respond. Okay, super. Now let's go back from here, right? We've got revaluation, we accounted for revaluation, no problem. But after that, we have depreciation. Depreciation, guys, remember we adjusted here minus 100. We went to property, plant and also adjusted, no? Correct? What your examiner says, it has to go to cost of sales here, correct? So cost of sales means you come here, under your cost of sales, you will add 100. Are we clear? Did you understand that? Everybody, yes or no? Did you understand that? Yes or no? Did you understand that? Yes or no? That is number one. Number two, guys. Okay. Number two, guys. Now this is done. Number two, guys. There is a decrease in liability which we spoke about. That is an income. So basically, that is an income. So basically, that has to be accounted also. We accounted that in our liability, and here no retained earnings no. So in our P&L also it has to be accounted, right? So we come to the P&L. We come to operating expenses minus 300. We'll deduct 300 there. It's easy. Makes our life easier. Are we clear? Well, basically, Abdullah, we are going to show NCI separately. So it will be adjusted when we show NCI. Don't worry. Take 100% and then we will make it, we'll make the changes below. Okay. Guys, do you understand? Are we clear? Okay, here what I did not, okay, now Atura, what's happening here is you are making a gain here, no? 300, do you understand? You're making a gain. That gain we adjusted here, right? Here we adjusted and we adjusted in current liability. It's a gain, no? So basically my profit should go up, no? So I'm coming to my operating expenses. From operating expenses, I'm deducting. My expenses coming down, meaning my profit is going up. Are you clear? Understood? Okay, brilliant. Now, we were here, we were looking at this. 13,000 eliminated. Now 13,000 eliminated, what is this? Intragroup transaction eliminated from sales and cost of sales. In other words, we don't have purchases. How much should I eliminate? 13,000. I go to the top. I come here. I have my revenue. From revenue, I deduct minus 13,000. From my cost of sales, I deduct minus 13,000. Understood? Yes or no? Understood? Yes or no? Everybody understood? Yes or no? Brilliant. Now coming back. Others, everyone. Everyone, I'm waiting for you. Nope, no impact. No impact. Statement of financial position is not impacted by intergroup transactions. Only intergroup balance has an impact. Okay. Brilliant. So there you go. We are here. That's done. Eliminated. At 30th September, Polestar, that is the parent, had 1.5 million of this goods still in inventory. So that means subsidiary sold goods to the parent. 1.5 million is there. So working number 7, I have unrealized profits, URP. How to calculate URP? Normally your examiner will give you the profit element. If the profit element is not given, very simple guys, try to understand. Total cost incurred when subsidiary sold it to the parent was 4,000 plus 1,400. No, that's the total cost incurred. No, correct. That's the total cost that they are selling it for. Am I clear? So the profit element will obviously be, when they are selling it for 9,000. So equals 9,000 minus 5,400, 3,600. Out of this 3,600. So now this is the cost, sales price. So your profit element would be, your profit element would be 3,600 into over 9,000, which is 40%. As a percentage, it's going to be 40%. So how much is the inventory, remaining inventory? Remaining inventory is 1,500 at 40%. That's going to be equals 1,500 into 40%. 600 URP has to be eliminated. Eliminated from whom? Eliminated from subsidiary, because subsidiary is the entity selling. So because they say Polestar had 1,500, so meaning subsidiary had. Are we clear? Are we clear? Are we clear? So how do I eliminate? I go to my assets, current assets. I come to my current assets. From current assets, minus 600. Subsidiary is selling, so I go to my subsidiaries retained earnings. Over here, URP minus 600. And then of course I have to remove it from my inventory. I go to my cost of sales. To my cost of sales, I add 600. Done and dusted. Understood everybody? Yes or no? Any doubts there? Any doubts? Any issues there? Any doubts? Any issues there? Any doubts? Any issues there? No. Understood. Explain again if possible. Okay. Now, listen. First thing, Polestar parent sold goods, transferred goods, raw materials, that is raw materials, unfinished goods at a cost of 4 million. Here, this is this 4 million. No? Did you understand that? 4 million. And then subsidiary is selling back to the parent for 9,000. They're doing some processing and selling back. Okay. Therefore, in total, there is 13,000 worth of transaction sales that would have been accounted by the parent and by the subsidiary. Now, this 13,000 is, when you combine together, that's the intergroup sales. No, that has to be eliminated. No, I eliminated that. Understood that? Yes or no? Understood that? Yes or no? Okay, super. And number two, when subsidiary sold the goods to the parent, they purchased it for 4,000 plus there is a direct cost of 1,400. No, so therefore total cost incurred by the subsidiary is going to be 5,400, and they're selling it for 9,000. No, therefore there is a profit element of 3,600. So on your balance inventory which is within the group, which is unrealized, you have to calculate URP. No guys, for the URP only you need to know the profit element. No, that profit element how to calculate? 3,600, that is your profit, over your sales price 9,000 as a percentage, which is going to be 40%. Understood? Yes or no? Okay, brilliant, super. Okay. Polestar's policy is to value the NCI interest at fair value at the date of acquisition. This was seemed to be 3.6 million. Okay, this is to calculate NCI goodwill. All items in the above statement of P&L are deemed to accrue evenly over the year unless otherwise indicated. So that means they want us to apportion the incomes and expenses. Are we clear? Okay, I'm going to give you a quick 2 to 3 minutes. I want you to go and look into these adjustments. I want you to go and look into these adjustments to understand if you understood and give me a done. Okay, quickly go through and give me a done. Go through the question entirely. I want you to go through and then obviously the answers and give me a done. Can I continue? Are you done? Everyone, can I continue? Yes, can I? Okay, guys, like always, we go back to the steps, right? Steps, adjustments 1, 2, 3, 4, 5, whatever the adjustments comes by, you're going to work around it. And then finally, you're going to calculate. Oh, there you go. Calculate first goodwill on acquisition. That's the first thing that you're going to calculate. There you go. First goodwill on acquisition, then consolidated retained earnings, then NCI share of net assets and consolidated revaluation reserve. Okay, first goodwill. Okay, don't miss that. I'm so sorry, miss that. Okay, anyway, coming back, we are here. Working number 8, my W8 will be consolidated. Sorry, goodwill on acquisition. Goodwill on acquisition. Okay, there you go. Goodwill on acquisition. That's my working number 8, W8. Okay, for goodwill, very simple. I need the investment cost. I have to deduct all acquired net assets. Now I have my parents goodwill, I have my subsidiaries goodwill in the exam. Okay, there you go. So parents goodwill. So I'm gonna take the investment cost. What's my investment cost? Don't forget, we already calculated on top. Guys, you got to be very well focused, so you can connect from here to there. You can connect, right? So immediate cash payment was 13,500, and then I have a deferred payment of 1,800. So therefore my investment cost will obviously be equals. In the exam, I would prefer to connect 13,500 plus 1,800. I will have a total of 15,300. Guys, whatever you take into the goodwill calculation, you don't take into the consolidated financial statements. For example, investment cost is 15,300 here. No? Immediately as I go to the top and I will see my investment cost here is 15,300. From here, I will deduct 15,300. Guys, it's consolidation adding. And we got to make sure there is no double counting. So I deduct my 15,300, making this 0. But instead, I will try to accommodate my goodwill. So let me go forward. Investment cost done. From this, I deduct my acquired net assets. Acquired net assets means what are the assets that I'm acquiring at acquisition date from the subsidiary. Subsidiary is there. Whatever I'm acquiring from the subsidiary, I have to take it. For example, I'm acquiring my net assets share capital. Here, it's easier for us to take the share capital. So I come here, my share capital examiner has given me 6,000. So I'm going to take 6,000. And then I have retained earnings. Now retained earnings, guys, like I told you, goodwill is at acquisition. Therefore, this retained earnings they have given me here is not at acquisition. Now this is an instant a scenario where most of the students struggle. You got to be very vigilant that you are only taking goodwill, which is for goodwill you take retained earnings which is relevant. In other words, which is at acquisition. Now here, this is the balance sheet date 12,000. That is your retained earnings here. But if you look here, this is at 30th September. We already did the timeline. 30th September over here, we've got the retained earnings which they say is 12,000. But is that relevant for us? Actually, no. Not for my goodwill calculation. They say 12,000, that's not relevant. Where do I need my retained earnings? I need retained earnings for goodwill at this point at acquisition. How do I get it? It's not a challenge. It's very simple. It's very, very, very easy. When you look here, this is 12,000. Remember, don't forget. But in the current year, subsidiary is making the subsidiary's profits or losses are given. But in this instance, it's a loss. So basically, if you look here, during this period, they have made 4,600. Since it's a loss, technically, as you started off, you would have started off with 16,600. You would have started off. You would have made a loss, and now you are at 12,000. So if that is the case, what would have been your acquisition retained earnings? What would have been your acquisition retained earnings? Think, use your kidneys and tell me please what would have been your acquisition retained earnings. What would have been your acquisition retained earnings? $4,600 is for how long? 4,600 is for 1 year. So here you have a period of 6 months to cover. Here 6 months to cover. At this point, what would have been the retained earnings? Think and tell me. Come on, you can't take this long for it. Okay, Shibi, good. Shibi, good one. Closing retained earnings is 12,000 given Amani. That's not the problem here. All what I want is here at this point, what would have been the retained earnings? It's a 2,300 loss. Brilliant. It's a 2,300 loss, which is between here 2,300 and 2,300. So technically, if you're going to work backwards, 12,000 plus 2,300, which would be 14,300 equals 12,000 plus 2,300. If it is profit, it would have been the opposite. Are we clear, everyone? Are we clear, everyone? Yes or no? Everybody, are we clear? Yes or no? Everybody. Guys, everybody, do you understand that? Yes or no? Understood. Okay. Now that is done, I will go and look for all the adjustments relevant for at acquisition. What are the adjustments relevant for at acquisition? I would have already put revaluation at acquisition relevant, I say. So I'm gonna look for everything. Depreciation, it's not relevant. Intergroup transactions happens post acquisition, that's out. Unrealized profit also happens after post acquisition, that's out. So basically the only thing that is relevant is revaluation. Our revaluation, when we acquired here, there is nothing. Therefore, at acquisition, they have not given anything, 0, and there is a gain in between, and the gain is going to be 2,000. I'm done. I'm going to take my total. There you go. In this, I'm acquiring 75%. So 22,300 into 75%, 16,725 equals 15,300 minus 16,725. 1425 is my loss. Listen to me very carefully. I'm going to explain you what this loss is about. Here, there you go. Your examiner clearly says it's a bargain purchase, my dear. It's a bargain purchase, my dear. It's a bargain purchase leading to negative goodwill. It's a bargain purchase leading to negative goodwill. It's a negative goodwill. A negative goodwill. So if it's a negative goodwill, we call it a bargain purchase. Can you include negative figures in the financial statements? You can't include. Well, in simple terms, with your net assets figure, whatever you have paid is a lesser amount, meaning you've made a profit. When you've made a profit here, add to retained earnings in the balance sheet. Statement of financial position. That is the first thing that you have to do. Second thing, it's a gain, add to the P&L. To profits, take it as a gain. Two things. I come here, my retained earnings, there is a gain. Amani, are you with me? So there is a gain, parent has a gain of 1425. Are we clear, everyone? Yes or no? Are we clear, everyone? Yes or no? Gain. So gain on goodwill. That is number one. Number two, yes, you go to your P&L from operating expenses minus 1425. This is coming down. Very simple. Okay, that is done. That is done. My bargain purchase is done. Now I go to my NCI goodwill. Not just that, we are supposed to calculate NCI goodwill. My NCI goodwill, I need my investment cost. What's my investment cost? We know your examiner has given you. They say the investment cost is 3,600. Are we clear? It's 3,600. Yes or no? Yes or no? So from the investment cost, I will deduct acquired net assets. My acquired net assets would obviously be, if you look here, exactly if you look here, I've got 22,300 from here. 22,300. In this, I have 25%. Equals 22,300 into 25%. 5575 equals 3,600 minus 5%. 1975. Once again, it's a negative goodwill. Negative goodwill for what? Negative goodwill for NCI. If NCI is negative goodwill as well, they have also purchased the company at a discount, at a low value. In that case, what you do, listen to me very carefully. NCI, what you have to do, it is once again, add to parents' retained earnings. It's a gain, number one. Number two, add to P&L because it is a gain. That's done. And then finally, deduct from NCI share of net assets. Meaning NCI share of net assets is the next thing. If the parent's retained earnings is going up, this has to come down. So the next working, whatever we are going to do, we are going to reduce the NCI share assets value. So there you go. My next working number one, like I told you in terms of my consolidation, I'm done with my goodwill. Once I'm done with my goodwill, yes, technically the second thing, although I put here consolidated retained earnings, I want you to calculate NCI share of net assets and then it's consolidated retained earnings. So I'm going to make a little change there, NCI, and then I want you to calculate consolidated retained earnings and then consolidated revaluation reserves. So next, NCI, so NCI share of net assets. Net assets. The moment you come to get to this point, your NCI share of net assets can be calculated. How do you calculate? You require your share capital. If you have share premium, obviously that, and then your retained earnings, whatever is lying under your equity, and then revaluation. Your share capital, obviously, you know your share capital is given here at 60,000, so no change there. 60,000 retained earnings as of today. NCI share of net assets at balance sheet date as of today. Now, for this reason only, we make adjustments here. For these reasons only, we make adjustments here. Where? Here. Now, at this point, I'm going to take my total here. And I'm going to take my total here. 11,300. What is subsidiaries retained earnings? Subsidiaries retained earnings is 11,300. I go to the top. I connect my 11,300. And then revaluation, that also as at the balance sheet date, I've made changes here. 0, 2,000. There you go. You come here. you can take the revaluation of 2000. You have the total. Therefore, your total NCI value will be 73,300. Out of this 73,300, so it's not 60,000, it's 6,000. Okay, 6,000. I'm sorry, 6,000. It's going to be 19,300. I'm sorry, it's 19,300. In that, NCI percentage is 25%. Therefore, equals this into 25% gives you 4825. This is the NCI share of net assets, but you have negative NCI goodwill. Here you can have shortcuts. Here you can say GW, all those are fine here, no problem there. Equals from here, I'm going to bring 1975. Therefore, my total sum will be 2850. That's my NCI share of net assets. Well, if you really want, there is another shortcut you can apply in the exam. Your shortcut is going to be your NCI investment cost. Your NCI investment cost, you know, is 3,600. NCI investment cost is 3,600. To this add, that means post acquisition profits. Post acquisition profit is PAT. From the point of acquisition till today, how much is the profit? Okay, so today at acquisition, today the profit we know it's 11,300. At acquisition, retained earnings is 14,300. So minus 14,300. Therefore, my sum is 3,000. In that, 25% is NCI equals this into this is 750. Therefore, 3,600 minus 750 gives you 2,850. Either way, you get the same answer. For MCQs, you can use this shortcut. But if you're doing a full consolidation question, I would recommend you to do the other one. Because if you do this, you will not be able to get the NCI goodwill. Because if it's a positive parent goodwill, probably you'll have to take the positive NCI goodwill and add it together and present it on top. Because of that. Are we clear? Do you understand? Do you understand? Yes or no? Super. My next working is going to be working number 9. This is going to be working W9. And then I'm going to have my working 10. My working 10 will be consolidated retained earnings. Like I've told you in the exam, keep this as your balancing figure. Don't calculate. Don't calculate this in the exam. Just leave it like that. That's okay. Just move on. My screen is blurred. Is my screen blurred? Because the weather is horrible here. No. Okay. Some say no. Okay, fine. Guys, your Indian question, please check that also. Okay. Working 11 is consolidated revaluation reserves. Consolidated revaluation reserves, how I can calculate? You take parents revaluation. Where do you take parents revaluation? You have already calculated here. You go to the top equals 0. And then subsidiary today and at acquisition. Today, where do you get it? Subsidiary today, you get it here 2000. Because our NCI has all figures relevant for today. Acquisition, our goodwill has all figures relevant for our acquisition 2000. 2000 minus 2000 is 0. Therefore, our revaluation reserve is also 0. My consolidated retained earnings in the exam, I will not calculate. I will not calculate. Guys, listen to me. You should not calculate. Why? Because you can get it as your balancing figure. Now I'm going to go to the top and I'm going to start balancing my question. Are you all ready? Are you all ready? Okay. Goodwill, I don't have goodwill because it is negative 0. Investment in associate is not there, it's 0. Therefore, my total here is 63,900. total non-current assets. My total current assets is 23,200. Therefore, I have my total assets, which is 87,100. Okay. And then I'm coming to my equity, consolidated retained earnings. I did not calculate. I'm going to just leave it like that. Consolidated revaluation reserve is 0. My NCI share of net assets, I calculated it. So equals, I have my NCI 2850. 2850 is my NCI. So I take my NCI 2850. That's it. I have to get my total equity and liability. Now this is where you're gonna be very smart in the exam. Equals 87,100 because it has to balance, no? So equals 87,100. Therefore, your consolidated retained earnings will be your balancing figure in the exam. Please take it as the balancing figure in the exam. Meaning equals 87,100 minus 30,000 minus 2,850 minus 24,300 gives you 29,950. That's your answer in the exam. I don't want you to calculate that in the exam. Are we clear, everybody? Are we clear, everybody? But for the purpose of proving it, I'm going to show you proof here. Okay, because you must not think we're just trying to manipulate here. No, because in the exam, under exam conditions, it's all about going further. It's not about doing one question. It's about finishing the entire paper. I'm going to prove it here because it is a fully fledged class. In the exam, I don't want you to do it because I want you to not get confused. Will you be penalized? No, don't worry. You're fine. So I want parents retained earnings. Parents retained earnings is how much? We calculated it. 30,225. And then where is my reserves? There you go. What do I feel like something is missing? 30,225. Yeah, correct. But guys, look here. We took 1425 gain. We did not take 1975 gain. Now look here, add to parents retained earnings. So we have not taken that. So I'm going to come back here. NCI goodwill gain 1975. Here I have a gain. So my total will go up to 32,200. That is one entry. And here, since it's a gain, I have to come here. I'm going to reduce my operating expenses by 1975, making it 7,000. There you go. I'm going to prove 32,200 today. Subsidiary, you're going to take today and at acquisition. Today, let me come to that chart here. Today, it's 11,300 today. My subsidiary is retained earnings. There you go. And when I acquired, it is 14,300, meaning equals 11,300 minus 14,300 gives me 3,000. But in this 3,000, how many percent is mine? How many percent is mine? 75% is mine. Who? Consolidated retained earnings. Into 75%, 2250 negative. Therefore, 32,200 minus 2250, 29,950. Your question is, the answer is correct. In the exam, I don't want you to do this. I want you to take this as the balancing figure. Are we clear? Okay. 1975. Okay, coming back. Shadia, do you understand this entire calculation? Yes or no? Do you understand this calculation? Yes or no? No. NCI is making an investment. when NCI is making an investment, you have to calculate NCI goodwill. NCI is making an investment, so you have to calculate NCI goodwill. How to calculate NCI goodwill? You have to take the investment cost, like how you took it for the parent. So your investment cost is 3,600. Where do I get it? I get it from here. Your examiner is given you. Sometimes he'll give you the share prices. Sometimes he will directly give you the figure. Like here in this case, your examiner has directly given you the figure of 3,600. So I've taken my NCI investment. From this, I deduct my acquired net assets. Acquired net assets, 75% goes to the parent, 25% goes to the NCI. 22,300 in 25% gives me 5575. In this case, the value is negative 1975, meaning the premium paid is less. You are not paying a premium, instead you are paying a discount which is lesser than the net assets. So therefore, what you have to do is you have to add to parents retained earnings. How to add to parent retained earnings? I've just added to parents retained earnings. There you go. 1975. That's the first entry. So my gain is going up. So I'm coming to my income, to my P&L. There you go. My operating expenses, I'm reducing it so that my profits will go up. Second entry. Are we clear? Shahadia, have you followed classes entirely, or are you a new student? Just to understand your background. So why is loss added instead of deducting it to return? It's not a loss, Arudra. It's a negative figure, meaning it's a gain. For example, this watch is 100,000. You pay 90,000. Okay, so you're paying less. So you're paying minus 10,000, but it's a gain for you if you do it. Okay, meaning you have not followed lectures with us. Have you been a student here, or you are a new student? I'm just trying to understand if I can help you anyway. Okay, fine. Just drop me a message. I'll see how I can help you. Okay. Brilliant. Okay, now that I'm done with this, I can work on my P&L. There you go. 20,700 minus 7,000 gives me 13,700 as my profit or loss before tax, and then I have my tax, which gives me 10,700. Now what I have to do, this is my group profits, and now I have to do my NCI share of profits. NCI share of profits is very simple. I'm going to take my subsidiaries profits. How much is subsidiaries profits? Subsidiaries profits are given here. 4,600. Subsidiaries profit is 4,600, but 4,600 is for 1 year, so into 6 over 12, which is 2,300. But it's a loss, so I'm gonna make it a negative loss. Any adjustments to this will be taken into consideration. I remember we had depreciation. Abdullah asked me, why aren't we giving it to subsidiary? There you go, NCI 100. Now I'm bringing it here, Abdullah. Abdullah, answering your question, minus 100. And also in this case, what else is affecting, depreciation is affecting, URP is affecting, because subsidiary is selling goods. So there is a 600 minus. So I'm going to come to the top. I'm going to deduct my URP minus 600. Well, anything else? I don't see anything else that is affecting my subsidiaries profits. Therefore, I take the total, which is 3,000. Out of this 3,000, how many percent is NCI? 25%. So equals 3,000 into 25% minus 750 is my NCI. Now, if you really want, this 750 is taken from here. You can take today minus acquisition into 25%. That will be your 750. Are we clear, everybody? Are we clear, everybody? Okay, brilliant. I believe I've made some impact to your studies with this question, but just drop me a message if you want any other questions to be done. I'll try to accommodate it during our marathon session. Okay. Next, I will be also looking at a PNL balance sheet question, another PNL balance sheet question tomorrow. I'm going to work on a PNL balance sheet question covering adjustments and accounting standards, including IFRS 9, if we are able to capture it. So, guys, thank you very much for being a part of the session. Tomorrow, once again, let's meet up at 6:30. Let's go on till 8:30. Guys, your examiner gives you the question. There are notes when it comes to income statement and balance sheet. So you will read the entire question. You will read your notes. Every note will have a working to do. So the workings will be adjusted here. So once you're done with the note, it's the workings which matters to you. Based on the workings, you will answer the question. Okay, we're going to take the route. Shall we, everyone? Everybody onto my screen. Right. Let's go to Fresco and let's start answering. Now, guys, something like this is definitely possible in your exam. Now, here you have a question which is worth 20 marks in the exam, right? It's tested in every exam session. It is there in every exam session. I'm going to take you through this entirely and show you how to work around a question like this. Okay. I'll be slow because I'm going to explain you some standards also when connecting this to the answers. Before that, the requirement says prepare the statement of P&L and other comprehensive income. You know the P&L and other comprehensive income for the year ended 31st March 2012, and then prepare the statement of changes in equity for Fresco for the year ended 31st March 2012. It's only the statement of changes in equity. They do not want you to do the statement of financial position. But let's say if possible, we'll try to do the statement of financial position also. Okay, brilliant. Everybody, can we start? Everybody, can we start? Everybody with me? Okay, brilliant. Take a minute, start reading the question on your own. Take a minute, start reading the question on your own. Just read the question and then we'll do it together. Just go through the question on your own. That's enough. Once you go through, give me a done, okay? So we didn't receive the recorded videos of your attending mock exams. Really? Okay. Let me look into it. Don't worry. Let me look into it. Okay, done. Others done? Done? Gone through entirely? Only now I'm scrolling down. How can you go through entirely? Ah, you went online. You have the book with you. But I saw your revision kit. No, you might have. Yeah, but your revision kit will definitely have it. You got it right? Okay. Right. Guys, let's go to the question. The trial balance, the following trial balance extract, it's an extract from the trial balance, relates to Frisco at 31st March 2012. What do you have? You've got equity shares. You've got equity shares of 50 cents each. 45,000. So when they say equity shares of 50 cents each, basically the total value would have been 90,000 shares. 90,000 shares at 50 cents means it gives you 45,000, correct? That would be your total number of shares. This is your value of shares. 45,000 is the value of shares. Number of shares is 90,000. Clear? Share premium. You know share premium. When your shares are issued at a premium, at a higher value, you have a premium. Number 3, retained earnings or profits accumulated over a period of time. Number 4, equity financial assets, IFRS 9 financial assets. Leased property, IFRS 16 leases. Plant and equipment, IAS 16 amortization of leased property, accumulated depreciation of plant and equipment, deferred tax, IAS 12, revenue, IFRS 15, cost of sales, once again lease payments, they've made for 8,000 I believe, distribution cost, admin, bank interest, current tax, and there is suspense account. So basically suspense account means what is happening, there is a difference. So trial balance will have to balance. No guys, it's not balancing. Because it is not balancing, probably you've done an error, you've made a mistake. That mistake is for 13,500. That's what your examiner says. Are we clear? Super. And then they've given you the notes. Now guys, based on the notes, you're going to do the workings. That's how it has to be in the exam. The following notes are relevant. The suspense account, meaning they are referring to this. Correct. The suspense account represents the corresponding credit for cash received for a fully subscribed rights issue. Meaning they've gone for a rights issue. When they've made the rights issue, they have accounted for the share issue. However, they say a suspense account represents the corresponding credit for cash received for a fully subscribed rights issue. The debit, when you're issuing shares, you credit your share capital, you debit your cash. So your debit, your cash received is accounted. The corresponding credit was not accounted properly. They say for cash received for a fully subscribed rights issue of equity shares made on 1st of January 2012. The terms of the share issues were one new share for every 5 held at a price of 75 cents each. Meaning, you go for a share issue, you make a share issue, you are going to debit cash or bank. Correct. You're receiving money. And then you're going to credit what? Share capital and share premium. Share capital with nominal value, share premium with any additional amounts. Here they say the debit side of it is adjusted. But the problem we have is on the credit side. So credit side, they have not accounted it correctly. Because they have not accounted it correctly, we are going to record it. Are we clear? Technically, you have how many shares? You have 90,000 shares. We just calculated on top, correct? 45,000 divided by 2. 45,000 divided by 0.5. 90,000 shares. So 90,000 shares, guys, you're issuing at 1 for 5. Correct. So if you are a shareholder, now rights issue, the concept of rights issue is basically if you are a shareholder, the company is going to give you shares. Company wants money. Now let's say PPIM wants money. We don't have enough money. For our money that we have to require, the money that we require, the capital, either I can go to the bank and I can borrow from the bank, or I can go to my existing shareholders. If I decide to go to my existing shareholders for money, for my capital, we call it a rights issue. Rights issue is normally given at a lesser price than the market value. It's a benefit to the shareholder. If the market value is, let's say, is $1, you can get it for maybe about $90, 0.90 cents or 0.80 cents at a lower value. So in this case, they are issuing at 0.75. So 90,000 shares into 1 over 5 into 0.75 is the value. So basically, how much are you looking at? You are looking at 90,000 into 105 into 105 into 0.75 is how much? Let me go to my Excel and do the calculation. 13,500. Sir, I'm very sorry to interrupt you. Your video is blurred. Is my video blurred? My video is blurred. Okay. Arutha says no. Others? No, it's not blurred for others. So probably it can be a problem in your end in terms of internet, Akash. Can you just log out and come back, please? We're fine with that. Okay. Okay. Now basically, what I'm going to do is, I'm going to do my W1, working one. Okay. Now there is a share issue. What is the terms of issue? You have 90,000 shares with you. Am I right? You are going for 1:5 ratio, rights issue. For every share that you are issuing, you are giving off at 0.75, meaning equals 90,000 into 1/5. New shares 18,000. 18,000 will be your new shares that you are going to issue, correct? That you are going to issue. Price will be 0.75. So total value will be equals this into this 13,500. Are we clear? Now basically when you look at this question itself, by now you know the 13,500 is already there. Are we clear? 13,500 is already there. But they have not accounted the credit side of it. The debit side of it is accounted. Now the debit side of this will be debit bank. No guys, you're going to debit bank how much? 13,500, correct? The credit side of this will be credit share capital and then credit share premium. Share capital, guys, you will only always credit with what? Nominal value. So total number of shares is 18,000 that you are issuing. What is your nominal value? What is your nominal value? 0.5. So into 0.5 is your share capital, which is 9,000, and the remaining will go as share premium, meaning 0.75 minus 0.5, which is 0.25. So equals 18,000 into 0.25 will be your share premium. Are we clear? Are we clear, everyone? Yes or no? Are we clear, everyone? Yes or no? Understood. Super. Now let's go further. Okay, in the exam, you need to keep in mind that this is done. If this is done, this is a problem. No? I mean, this note is a problem. The problem, for this problem, we've got the solution. So once we have the solution, we are not going to go to the problem again. In the exam, I'm not going to come to this particular area again at all because I'm done solving this problem. So my workings are good enough for me to prepare my financial statements. So this is done. I'm going further. My note number 2 is non-current assets. They say, to reflect a marked increase in property prices, Fresco decided to revalue its lease property on 1st of April 2011. Now, when is this happening? Where did I go? There you go. So coming back, to reflect a marked increase in property prices, Fresco decided to revalue its lease property on 1st of April 2011. 1st of April 2011. Now, what's your year end? Let's go back. What's your year end? Your year end is 31st March 2012. So, from 1st of April to 31st March, how long has it been since you revalued? 12 months. Super. The directors accepted the report of an independent surveyor who valued the leased property at 36 million on that date. So you had an independent valuer, an expert, who came in and who said the value of the property is 36 million. So that means your fair value is 36,000 on that particular date. So you are going to do a revaluation exercise, no, my dear. So when it comes to a revaluation exercise, you compare your fair value with your book value. So now you have to get your book value. Now you have your fair value. Now you need your book value. Are we clear? Book value, how to get? You can go to your trial balance and you can get your book value. Now what are we revaluing? We are going to revalue the property. So if you come to the top, they have property. There you go, leased property. The value of leased property is 48,000. And then you have what? Accumulated depreciation. So the net book value would be your property's cost minus accumulated depreciation of 16,000. How do you revalue? For your revaluation, you require your fair value, the revalued amount, and your net book value. The difference between your net book value and your fair value will give you your revaluation gain or loss. So basically here, when you look at this particular question, particular adjustment, that is working number 2, is revaluation. Is revaluation. For revaluation, what do you require? Net book value and fair value. Correct. What is your net book value? Your net book value will be 48,000 minus 16,000. How much is that? 32,000. Are we clear? Are we clear? How much is your fair value? Your fair value is 36 million. So 36 and 32. Do you have a gain or a loss? What do you have? You have a gain. So there is a revaluation gain of how much? Gain of 4,000. Now how do you account for this revaluation gain? Your asset value is going up, no? So you are going to debit your property account and credit your revaluation gain account. Surplus account. Everybody, are we clear with that? Yes or no? Everybody, are we clear with that? Yes or no? Clear? Super. Now let's go further. Fresco has not yet recorded the revaluation, so we recorded it. So that particular adjustment is done. The remaining life of the leased property is 8 years at the date of the revaluation. So when you revalue, at that point, you calculated, you are calculating your useful life. You are estimating your useful life. The estimated useful life of the property is 8 years. Meaning, what's next? What's the next adjustment that we have? Next adjustment, what do we have? Depreciation. W3, depreciation. There you go. So you have your cost now. Cost is 36,000. Depreciation is how many years? 8 years, correct? 8 years. Therefore, depreciation value will be equals 36,000 over 8, which is 4,500. Are we clear? Get online. Are we clear? Everyone? Okay, double entry. Debit cost of sales. In the exam, your examiner wants you to take it to cost of sales, so you debit cost of sales. Credit accumulated depreciation. Debit cost of sales and credit accumulated depreciation. Now, okay, Ziyan, look, cost of sales, my school teacher told me, my accounting teacher told me, okay, you don't take it to cost of sales, you take it to distribution cost. That's how I studied in my school. No, 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 no. Your examiner, FR examiner, has two PhDs in accounting. Your examiner says to take it to cost of sales, take it to cost of sales. Your examiner says to set it off against revenue, set it off against revenue. Your examiner says to take it as a part of any expenses, take it a part of any expenses. Now, don't try to argue with your examiner. No, 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 Ivan Pila, he is wrong, I am correct. Don't try to negotiate things like that with the examiner. Your examiner says something, please do it. And who is your examiner? Examiner is directly monitored by one of the persons who is that is SBR examiner. Your SBR examiner is a part of the IASP board. Do you know what's the board? International Accounting Standards Board. It's a panel of experts who set accounting standards. Now, for example, let's say IAS 16, your examiner is a part of that board. So, examiner doesn't go to Kaplan or study up or anything like that. Examiner sets their own accounting standards and they work on questions based on that. So, don't try to negotiate or challenge the examiner. Okay? The examiner says cost of sales, please take it to cost of sales. Clear? Okay, done. Fresco makes an annual transfer to retained profits to reflect the realization of revaluation surplus. In Fresco's tax jurisdiction, the revaluation does not give rise to a deferred tax liability. Now, all this looks very complicated. Yeah, don't complicate yourself. Let's take it very slow. Okay, it's something very simple. Don't try to confuse yourself. Okay, I think this is where most of the students got confused. Okay, Ziyan, what is this annual transfer to retained earnings? What is this annual transfer to retained earnings? Fresco makes an annual transfer to retained earnings to reflect the realization of revaluation surplus. In Fresco's tax jurisdiction, the revaluation does not give rise to a deferred tax liability. So don't worry about that. Now let's try to understand what do they mean by this, right? Now guys, hopefully can I use this? Now guys, let's take a building. Let's say you have a building, right? The value of the building is $1 million, for example. Okay, how much is it? $1 million. Now what is happening? You're going to revalue the building. You're going to revalue the building to 1,500,000. So if you revalue, there is a 500,000. What is this? It's a gain. Where do you take the gain? OCI. Brilliant. Why do you take it to OCI? Why do you take it to OCI? This gain does not impact profits because we don't show it as a part of our P&L. We show it separately under other comprehensive income. Why? Because it's not a realized gain. Just because I say the value has gone up, now we have this premises, right? It's about 10,000 square feet premises. This will easily go about 250 million. About 20 crores, this property will easily go. It's big, it's massive, right? So I say 200 million today, but tomorrow I say 300 million. Next week I say 400 million. So I can increase the value. But just because I say, is there cash flows coming in? No, it's not realized cash flows. Because it is not realized cash flows, I have to take it to other comprehensive income. Why? If I take it to my P&L, to my profits can be overstated. Yes or no? I can simply use this. To overstate my profits. If I am allowed to take it to my P&L, simply because of this, I have to take it to other comprehensive income. Clear with that? Okay. Now there's another problem. Let's say this building's useful life is 10 years. So I would have charged 100,000 depreciation every year before revaluation. Let's say I revalue. After I revalue also, the useful life is 10 years. Now how much will I charge? 150,000 every year. Correct? Correct. Depreciation. Does this affect my profit? Yes or no? Is it a P&L item or OCI item? P&L item. Yes or no? Are you sure? Just now, right before I told you it comes under cost of sales, right? Then how did it go to admin? Okay. Anyway, it is a P&L item or a OCI item? P&L item. Okay. At least that you are confident, right? So yes, P&L item. So if it's a P&L item, it affects our profitability. Yes or no? Yes or no? If it's a P&L item, obviously, right? It affects our profitability. So that means depreciation by default, it affects our profitability. Yes or no? But now I'm going to revalue. The value goes up. But does this value affect our profits? Does this value increase in value? When it comes to a revaluation, does it affect our profits? No, because we take it to OCI, right? Other comprehensive income. That's what you told me, right? However, if I revalue, my depreciation is going up. Will this increase my profits? Decrease my profits? Will an increase in depreciation impact my profits? My dear, yes, it will. Because last year I was charging 100,000. This year I'm going to charge 150,000. From last year to this year, there will be an increase of 50,000 in my profits. In my depreciation. Meaning my profits will come down by 50,000. Yes or no? Okay. Now here I am not allowed to take this 500,000 to my P&L because it is unrealized. But my profits are being affected for something unrealized by 50,000. Meaning my profits are coming down by 50,000. If it's unrealized, I have to take it to OCI. But the impact of that is bringing down my profits because my depreciation is going up. Is it fair or unfair? Unfair. Companies did not revalue as a result. Why? Because if I revalue, I have to take it to other company's income, show it separately. But my profit is coming down, meaning from a board of directors point of view, directors' performance is coming down. Because of that, it's a choice, right? Cost and fair value model. Because it's a choice and it is affecting their performance, they did not revalue. Standard identified, okay, there's a problem. There's a confusion. So standard wants to give a solution for a problem, right? So because of that, the standard came out with a solution. The standard says, okay, fine, we understand there is additional depreciation as a result of revaluation. Additional depreciation as a result of revaluation. Revaluation is taken to other comprehensive income. But this additional depreciation is affecting your profits. We want you to revalue, but we want you to revalue comfortably without affecting your profits. Because of that, this additional 50,000 is there, right? We are allowing you to reverse it. Reverse it as a gain to retained earnings. Meaning, you will charge depreciation, debit depreciation to cost of sales maybe 150,000 and credit accumulated depreciation 150,000. From last time to this time, what is the increase in depreciation? 50,000. This 50,000, you can reverse it in statement of changes in equity. How do you reverse it? Your profit has come down, no? Your profit has to go up. You will credit your retained earnings, that is your profits, by 50,000. And there has to be a debit entry, right? Obviously, if there's a credit entry, there has to be a debit entry, right? Standard says set off against revaluation reserve itself. Meaning you will debit your revaluation gain 50,000. We call this excess of depreciation transfer after revaluation. Excess of depreciation transfer after revaluation. Clear? Now here in this case, if you look here, they are revaluing now. Okay, they say the remaining life of the leased property is 8 years. In other words, before revaluation, what is the cost of the asset? Excess depreciation would obviously be, now look here, listen to me very carefully. You had 32,000, your useful life was how many years? 8 years. And then it became 36,000, till it's 8 years. So equals 32,000 over 8 gives you 4,000. Now 36,000 divided by 8 gives you how much? 4,500. How much is the excess depreciation? 500. This can be transferred to retained earnings. Whatever you are charging here, in excess is set off against the revaluation reserve. Meaning here what we can do is we can credit retained earnings, debit what? Revaluation reserves. 500. Understood? Yes or no? Understood everyone? Yes online? Understood everyone? Now here, in this particular instance, when they say Fresco makes an annual transfer to retained profits to reflect the realization of revaluation surplus, that's what they mean. So don't get confused. It's a very simple, straightforward thing. But now you know the logic. Okay? In the exam, you have to look at the difference and set off the difference. Don't worry, with this question, I'll teach you how to do that also. Super. Guys, in every exam session, you will get non-current assets tested. At least for about 3 to 4 marks. It is tested in every exam session. In every exam session. How much is it tested for Shadila? Shadila, right? Shadia, how much is it tested for? 3 to 4 marks. Are we clear? Brilliant. That's done. On 1st April 2011, Fresco acquired an item of plant under a lease agreement. The moment you see lease agreement in the exam, forget about everything. Just put up a T account. That's it. You see leases, just put up a T account. One T account. Working number 4. Lease payable account. We put up a T account. We call it lease payable account. That's it. Nothing else. Let's not confuse ourselves. Okay? Very simple. So let's insert. There you go. A T account. You don't have this flexibility in the exam. You have to just simply make sure that You can do it on your working paper. You can use working paper. You will be given A4 sheet papers. You can do it in that also, no problem. I'm happy. There you go. I want you to simply put up your lease payable amount. That's it. That's it. Nothing much. Look here. I'll give you time to write. Look here. Don't worry. I'll give you time to write. Try to understand. In the exam, when it comes to leases, you have few things that you need to get. Number one, you need to get the net book value of the asset. Net book value is your cost minus depreciation. So for that, you need to get your depreciation. So that's the second item that you need to be familiar with. Number three, you need to know lease payable for current liability. Non-current liability lease payable is also required, and finance cost. These are the 5 things that you need to know. Okay. Now, even before reading the question, all what I did was I put up the T account. That's it. First condition, T account. Second thing, you need 5 elements, 5 things from the note. You need to calculate depreciation, NBV, net book value, lease payable for next year, non-current liability lease payable, and finance cost. Okay. Now let's go to the note. On 1st April 2011, what's your year end? Always keep an eye on the year end, 31st March. So how long has it been? It's been a year. On 1st April 2011, Fresco acquired an item of plant under a lease agreement that had an implicit finance cost of 10% per annum. This is your finance cost. Lease obviously comes with a finance cost. Now they're not going to give you free of charge. The lease payments in the trial balance represents an initial deposit of 2 million paid on 1st of April 2011, and the first annual rental of 6 million paid on 31st March 2012. Now you are paying your rental of 6 million on 31st March 2012. You acquired on 1st of April 2011, but your first installment you are paying on 31st March 2012. You are paying in advance or in arrears. Oh, well done, Neha. You are brilliant. Advance or in arrears. Okay, let me tell you. In advance means you pay and use. In arrears means you use and pay. Arrears. Why? Because you are acquiring on 1st of April 2011, but you are making your first payment on 31st March 2012. Correct? Correct. The lease agreement requires annual payments of 6 million at 31st March each year for the next 4 years. For the next 4 years, you are going to make payments. The present value of the lease payments, excluding the initial deposit, was 23 million. Plant and equipment is depreciated at 20% per annum using the reducing balance method. Next, it's about depreciation. We'll come to that. Don't worry. Here, you put up the T account, no. Lease payable. Payable is a liability account, no. All what you need is the brought forward figure. Correct. Payable is a liability account. Liability is in the debit or credit side. Credit side. You require the brought forward figure. Brought forward figure is your present value figure. How much is this? 23,000. Always exclude the deposit. For deposit, you don't have to pay interest, no idea. So you have to exclude the deposit. Sometimes your examiner would have said, no, it's 25,000 including the deposit. So deposit is 2,000. They've told you already. So you will remove it and you will say 23,000, for example. Are we clear? Are we clear? Okay. So brought forward 23,000. Shadi, look here, I'll give you time to write. Take it easy. Come down. I'll give you time to write. Take it easy. Now you have your brought forward figure now. So on this, every year, if you're taking a loan in terms of lease, you have to pay finance cost, correct? So the next component is finance cost. So you need to know on your liability, you have to pay finance cost. and then every year you are paying cash. No, that has to be deducted as well. So you take your cash this thing also. Every year, how much are you paying? How much are you paying every year? Get online, how much are you paying every year? 6 million. So 6,000. Credit cash, debit this account. Simple as that. And then you have the finance cost. Finance cost is in advance or in arrears? In arrears. So arrears means it's your 10%, no? So equals 23,000 into 10%, 2,300. If it is in advance, this 23,000 minus 6,000 into 10%. But if it is in advance, you have already made the payment, no? Therefore, you don't have to calculate finance cost on that particular year. If it is in arrears, you're going to pay as at the year end, no? So therefore, finance cost has to be calculated. So therefore, 23,000 plus 2,300 is 25,300. 25,300 carried forward. 25,300 minus 6,000, 19,300. Was that difficult? No. But one thing that you need to keep in mind is, right now, currently, your year is 31st March 2012. Correct? 31st March 2012. No. From the point of acquisition till now, how long has it gone? When did you acquire? 1st of April 2011. Today it is 31st March 2012. How long has it been from the point of acquisition? 12 months. If it's 1 year. If it's 1 year, your calculation will go on till next year. Let's say from the point of acquisition to your year end date, it's 2 years. Your calculation will go on till the 3rd year. If it is 4 years, then how long will it go until? If it's 4 years, until 5 years, you have to do the calculation. If it is 9 years, but you know, in the exam, your examiner won't go for 9 years. It will just be 1 or 2 years. That's it. So in this case, for how long will I calculate? Twice. So this is your first year. On top, that's your first year. Now we are moving on to your second year. So second year, very simple, right? In the exam, you are brought forward equals 19,300, no? Correct? Okay. All what you have to do is come here, copy, paste. Copy, paste. That's it. You get your answer in the exam. Simple. Now, what you got to keep in mind is 1 year since acquisition to my reporting date. So I have done my calculation for 2 years. If it's 2 years, I'll go on for 3 years. That's the mindset. Here I stop at this point itself. At this point, I require few things. What do I require? I need the net book value of the asset. Net book value. For me to get my net book value, I need the cost of the asset. No. What is the cost of the asset? 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 Well done, Mervin. Well done, Shenuri. Cost of the asset is 23 million that you are paying here, plus your initial deposit of 2 million. That's the total cost of the asset, right? Or in other words, Okay, they are showing it separately. Okay, there you go. Your cost of the asset is 23 plus 2, 25. So there you go. Your cost of the asset is 25 million. Your depreciation. What is the depreciation policy? How many years? The lease agreement requires further annual payments of 6 million on 31st March each year for the next 4 years. So 4 years, current year 1 year, total 5 years. Useful life. Brilliant schedule. So that's going to be 5 years. In other words, 25,000 over 5. 5,000 will be your depreciation. Therefore, technically, if you look at the net book value equals 25,000 minus 5,000, 20,000 is the net book value. Relevant for my balance sheet, correct? 5,000 is my depreciation. And then I have my current liability. Current liability is always, current liability, my guys, my dear students, please listen to me. Current liability is always equals 6,000 here, A. Cash is A minus 1,930, 4,070. That's your current liability. Your non-current liability is always C. So I can say A, B, C. If it is in advance, it will change. When I do an advanced question, perhaps I'll explain you that. So A minus B is my current liability. C is always non-current liability when it comes to arrears. And then I have my finance cost. I've already calculated. 2,300 is my finance cost for the current. That's it, done. Are we clear? Okay, if you want, you can copy it. Okay, guys, like I told you, lease is also an important area in your syllabus. It will be tested. It can be tested for about 4 to 5 minutes. So there you go. We're done with this point as well. Are we clear? So far? Yes, are we clear? Yes or no? Yeah. And then they say plant and equipment other than the lease plant is depreciated at 20% per annum using the reducing balance method. And finally, they say no depreciation or amortization has been charged on any non-current asset for the year ended 31st March 2012. Depreciation and amortization are charged to cost of sales. So depreciation is one of your examiner's favorite areas, and in every exam session you see depreciation. And it's not tough as well. I mean, obviously from grade 8, 9, 10 you're studying depreciation, but if you're a science student like me, probably you get to know depreciation when you start ACCA. So yeah, that's where you start, but that's okay. You can still be successful. I have to tell you, if you're a science student, most of the time science students are very successful when it comes to ACCA. I'm not joking. Most of the prize winners, when you see, it's science students. They tend to grab it very quick. But anyway, depreciation is a straightforward thing, and I want you to start calculating it. I'll give you a minute. Let's see if you're getting it right. If not, let's do it together. Okay? You want me to go to the top? There you go. They say plant and equipment other than the lease plant. Lease plant we have completed, we have done with the depreciation, so we don't have to worry about that. It's depreciated at 20% per annum using reducing balance method. So you've got your plant and equipment at cost here 47,500, correct? Your accumulated depreciation for plant and equipment is 33,500. So they are using the reducing balance method. So let's go back. W5 working 5, depreciation of plant and equipment. So it is reducing balance method, so you don't have to worry. Cost minus accumulated depreciation. How much is the cost? Cost is given as, hello, you okay everyone? Yeah, please give me the answers. 47,500, brilliant. 47,500, and then you have 33,500. So 33,500. This less this 14,000 into 20%, 2,800. Correct? Are you clear? Understood? Are we clear? Yes or no? Okay, brilliant. So debit cost of sales, credit accumulated depreciation. There you go. So we are entirely done with this working, right? Guys, generally this particular adjustment entirely will give you about 5 to 6 marks in the exam. It's crucial, right? 5 to 6 marks in the exams. Yes or no? Not crucial. Yeah, obviously, right? It is, right? Okay, let's go back to the third point. In March 2012, so no depreciation amortization has been charged on any non-current assets. We have already calculated for everything. And depreciation and amortization are charged to cost of sales. Examiner says cost of sales, no negotiation. My teacher told me distribution cost, A-level teacher, O-level teacher, no, forget about it. Cost of sales, examiner says we take it to cost of sales. No negotiations there. Okay, brilliant. In March 2012, Fresco's internal audit department discovered a fraud committed by the credit controller who did not return from a foreign business trip. Okay, so you have a credit controller, this bugger went on a foreign business trip after committing a fraud. The outcome of the fraud is that 4 million of the trade receivables have been stolen by the credit controller and are not recovered. So 4 million not recovered. Who did it? The credit controller. Of this amount, 1 million relates to the year ended 31st March. So out of this 4 million, 3 million to the current year, 1 million to last year, and the remainder to the current year. Fresco is not insured against this fraud. If you have not insured against this fraud, you are not going to receive any money from the insurance company. So 4 million, it's entirely your loss. Are we clear? Yes or no? So basically, out of this 4 million, 3 million relates to this current year. You are not going to receive this. But 1 million relates to the last year, previous year. Therefore, how do you account for this 1 million? How do you account for this 1 million? Yeah, anyway, this 4 million is irrecoverable, right? Not just 1 million. 4 million itself is irrecoverable. Well done, Akash. Deduct from opening retained earnings. This 1 million will be accounted in line with IAS 8 accounting policies, changes in estimates and error. IAS 8 accounting policies, changes in estimates and error says that error is technically, error can be intentional or unintentional. If it's intentional, it is fraud. If it's unintentional, it is a misstatement. So, errors, basically error in the financial statements, can cause due to a fraud or a misstatement. Fraud is deliberate. Fraud is deliberate. Maybe this deliberation can come from pressure. My wife wants to go on a honeymoon package. I don't have money. Probably I'll try to steal. She says, no, if only if you go on the honeymoon package, I will not probably divorce you. Could have happened to A.R. Rahman, right? But obviously A.R. Rahman doesn't have to steal. Right? They got divorced. Yeah. And when they got divorced, A.R. Rahman's assistant also got divorced, right? So I don't know why they got divorced. But anyway, coming back, error can be intentional, which is a fraud, or unintentional, it can be a misstatement. In this case, it is intentional. IAS 8 says, if you have error not discovered from last year, if you are bringing it this year brought forward, it has to be adjusted in the opening retained earnings. Meaning, guys, this 1 million has to be adjusted in the opening retained earnings. The 3 million has to be technically set off in the current year, but entirely 4 million is not recoverable. So working number 6 W6, we have a fraud. So I'm not going to receive my trade receivables entirely, so I credit my trade receivables. How much? How much do I credit? I will credit 4 million. I'm not going to receive this entirely. I will debit my current year P&L with 3 million, and I will debit opening retained earnings 1 million. Are we clear? Are we clear? Understood? Okay. Last point. Taxes. Oh, sorry. One before the last. Taxes, but most important. Shadia, you go to the examination hall. You don't see a tax calculation in the examination hall. What are you going to do? Huh? You don't see. It is not there in the examination hall. What are you going to do? No. You just stand out of the examination hall, come out. There can't be an FR paper without tax adjustment. Every exam paper of FR will have tax adjustment. So basically, you have applied for the wrong paper. That's the reason you have to come out of the examination. Probably you have applied for tax or FPM or something like that. Every FR exam will have this tax element for about 3 to 4. How do you do it? You need to know my steps. Apply the steps, you will get the answer. Okay? Shall we? Shall we? Okay, let's read the question. Fresco's income tax calculation for the year ended 31st March 2012 shows a tax refund. Okay, forget about all those. Forget about all those. We don't need all those. We don't even have to read that point. What are my steps? Tell me my steps. Step number 1. What do we do? Put up 3 T accounts. It's simple as that, right? There you go, Akash. Brilliant. Put up 3 T accounts. Okay, that's it. Very simple. Okay. So let's put up 3 T accounts. Okay. T account number 1. Okay. If you want to go, you go. Okay. It looks like, she's hungry. If you want to go, you can go. Okay. But if you want to stay, you can stay. So guys, we are going to put up 3 T accounts. This one, it's detailed. Very detailed. But for you, it looks like it's LL accounting. You know the FAR paper of AAT, right? You did AAT, right? I taught that paper. Okay, I did FAR and I taught FCA. That's only about 10% of the syllabus. A level, if you take about 15% of A level, such very detailed. Yeah, so you put up 3 T accounts. 3 T accounts. You call it income tax account. There you go. Tax payable account. Tax payable account. And then deferred tax account. Guys, was that difficult? Now, if you come and tell me that is difficult, please stop doing ACCA. Putting up 3 T accounts. Was that difficult? No. What is the second step? Take the brought forward figures. Brought forward figures, where do you get it from? You go to the trial balance. Okay. What are the brought forward figures? You have your current tax here. You have the deferred tax here. Yes or no? Current tax is on the debit side, 800. Deferred tax is on the credit side, 3200. Correct? So brought forward 800 and then brought forward 3200. 100. Done. Oh, wait, I'll give you. Don't worry, we are not competitors. I'll give you time to write. Okay. I did FR like 10 years back. Don't worry. Okay. I'll teach you everything that I know. I will teach you. Don't worry. I'll teach you everything, every little thing. I'm not your competitor. Okay. Don't try to compete with me. Okay. Let's go down. Fresco's income tax calculation for the year ended 31st March 2012 shows a tax refund of 2.4 million. Guys, if it's a profit, you pay taxes. If it's a loss, you get a tax refund. Now, what do I mean by tax refund is HMRC won't come to your home and give you money. No. You're making a loss, so it's unfair to charge tax on you. When you make a profit, it's fair to charge tax on you. So if it's a loss, you don't have to pay tax. Instead, you get a tax refund. Not that you're going to get money to your account. No. When you make profits in the future, you can set off. So you'll have a credit entry with you. You'll have some asset with you. So when you have to make, I think your lecture is starting the class. No, please not. So when you make a profit, you can set off this loss against the profit. You understand my point? So you pay taxes when you make a profit. Now, in this case, technically the company is making a loss. In other words, the moment your examiner says this, you know when you're calculating your P&L, it has to be a profit or loss. When you're doing your P&L, it has to be a profit or loss. Your final figure. There has to be a loss, no, because your examiner is saying it's a tax refund, no. You pay taxes only when you make a profit. So in this case, when your examiner is saying it's a tax refund, your P&L, it has to be a loss, right? So they say it shows a tax refund of 2.4 million. Meaning, all this while you debited income taxes and you credited tax payable, no. Now you're going to reverse it. You're going to credit income tax and debit your tax payable account. You're going to show a receivable. How much will the receivable be? It will be 2,400. You will come to your income tax account. You're not going to debit it. Instead, you're going to credit it. You're going to say tax asset. How much is that? 2,400, 2,400. And then you come here. You don't have a payable. Although I call it payable, it's a receivable. We'll show it as an asset. We'll say income tax 2,400. Are we clear? Are we clear? Are we clear? Understood? Now let's go further. The balance on the current tax and trial balance represents the over or under provision of the tax liability for the year ended 31st March 2011. At 31st March 2012, Fresco had a taxable temporary difference of how much? 12 million, requiring a deferred tax liability. The income tax rate is 25%. Accounting written on value minus tax written on value into tax percentage. Sometimes they'll directly give you the deferred tax value. Sometimes you'll have to do the difference. They'll give you the accounting written on value and tax written on value. Sometimes they'll deduct and give you the tax base. Now here when they say temporary difference, they have already calculated the difference and given you this 12 million. All what you have to do is 12 million into 25%. In other words, carried forward will be equals 12,000 into 25%. That's it, done. $3,200, you have a 200. Where do you take this 200 to? You'll take it to your IT income tax account. Well done, Neha. So you come here to the top. If it's a debit here, you are going to credit here, correct? So you're going to say deferred tax how much? 200. Total 2600 minus 800, 1800. Where do you take? P&L. Debit or credit? P&L. You debited here means P&L will be credited. And then 2400 carried forward, 2400 brought forward, it will be a tax asset of 2400 on your debit side. That's it. Was that difficult? You want to copy? You can copy. Done? Okay. The investments had a fair value of 7.2 million as at 31st March 2012. There were no acquisitions or disposals of these investments. You look here, they say equity financial asset investment is 6,000. So that means you've got W working 7 taxes and then working 8 investments. You have two things, book value and fair. Correct. Book value is 6,000. Fair value is 7,200, meaning the value has gone up. So the value has gone up, is it a gain or a loss? 1,200 fair value. Okay. Now they say it's equity financial asset. Equity financial asset. Condition satisfied or not satisfied? Business model test, cash flow test. Equity financial asset means where do you take it? Well done, Mervin. Good job. Cash flow test, business model test. Well done, superb, Mervin. Well done. How would you indicate a day? You've never heard of something like that. So, guys, this is an IFRS, and I mean, obviously, I can't take you through in detail. I don't have the time. But we've got conditions for taking to fair value through OCI or fair value through P&L. If it's fair value through P&L, conditions not satisfied. What are the conditions not satisfied? Business model test and cash flow test. Business model test means you are going to hold the investments until maturity. Cash flow test means you expect constant cash flows from the instrument. Maybe you're talking about capital repayments and interest payment. Now, when you take equity, do you have maturity period? When you are investing in ordinary shares, do you have a maturity period? No, you don't have a maturity period. So if there is no maturity period, that means business model test is not satisfied. Therefore, you take it to the P&L. So because there is a gain here, 1,200 fair value taken to the P&L. In other words, you will debit your investments, credit the P&L. Are we clear? Are we clear? Take it and let's do the P&L together. P&L comprehensive income together. Sorry guys, there was a parent who came and I was talking to the parent. Okay, done. This is done now. Shall I do the P&L? In the exam, this is how it's going to look like, okay? We're going to have split view. This is exactly how it will look like in the exam. So we're going to work on Fresco's P&L. So Fresco's statement of profit or loss for the year ended 31st March 2012. Are we clear? Are we clear? Shall we? Shall we do it? You're going to do it or shall I do it? Or shall I do it together? Let's do it together. Okay. Number one, revenue. How much is your revenue? Your revenue is 350,000 over here. So equals 350,000. Did you make any adjustments to revenue? No, you should know. By now you should know your workings. No, revenue did not make any adjustments. So next, cost of sales, correct? So for cost of sales, what do you need? You go to the question, how much is your cost of sales in the question? They say the cost of sales here 298,700, correct? Did you do any adjustments? Yeah, you did adjustments. So you have to go back to your workings, not to your notes. You have to go to your workings, not to your notes. Your workings, your share issue, no impact. Your revaluation, no impact. There you go. You have depreciation. How much is that? Number one, 4,500. Number one. What else do you have? 4,500 is accounted, and then for leases also you have depreciation. How much is that? 5,000. Brilliant. Plus, and then what do you have? Once again, plant and equipment 2,800. Correct. Anything else? Fraud, I have to debit P&L. I'll take it to my admin expenses. Okay. And then I have taxes. And then I have investment. So that's okay. I have total of 211,000. Done. Next gives me my gross profits. 350 minus 311, 39,000. Are we clear? Next I have my admin expenses. How much is my admin expenses? They say admin expenses is 26,900. Correct. Equals 26. So before admin expenses, yes, that's right. I have to take my incomes, other income. In my other income, there is a fair value gain. Correct. How much is the fair value gain? Do we have any incomes here? No, right? So how much is the fair value gain? We had 1,200, is it? Yeah. 1,200. That's a fair value gain. After the income, what do I take? Admin expenses and distribution cost. Not cost, it is cost. Admin expenses is 26,900. 26,900. Do I have any adjustments to make? Let's come to the workings. Depreciation, leases. There you go. Fraud. I have a 3,000 to increase. Am I right? So plus 3,000. There you go. 29,900. And then I have distribution costs. Distribution cost is 16,100. I remember we did not make any adjustments to distribution cost. Correct. So I have my operating profits. Are you clear? So equals 39,000 plus 1,200 minus 29,900 minus 16,100. I believe it is a loss and not a profit. 5,800 loss. Are we clear? So we have an operating loss. Do you remember your examiner says it's a loss, right? There you go. Once that is done, I have to account for finance cost. How much is the finance cost here? Finance cost here is 300. They have already given in the P&L. Correct. Did we do any calculations? Yes, leases 2300. There you go. 300 plus 2300 gives me 2600. And then I have my profit before tax equals minus 5800 minus 2600, 8400 negative. Correct. And next I have my taxes. Taxes also we calculated, but this time we have a tax refund, right? Remember, how much is that? 1800. So it's a positive figure, yes or no? Generally taxes are negative, but in this case it's a credit entry. So therefore equal sum, how much do we have? 6600. Loss after tax. It's LAT, loss after tax. Are we clear? Done? Guys online, are we all clear? Yes or no? Okay. Shall we also do the statement of other comprehensive income? Okay. Fresco's statement of other comprehensive income for the year ended 31st March 2013 or 12? 13 or 12? 12. Okay. What do I need when it comes to statement of changes in equity? Actually, my equity section in my balance sheet. So I'll have my brought forward. I will have my share capital, share premium, revaluation reserves, and then retained earnings. These are my brought forward figures. Okay, share capital brought forward is how much? 45,000, correct. Share premium is how much? 5,000. Revaluation brought forward 0. Retained earnings brought forward 1, 2, 3, 5,100. Did we do any adjustments here? Your share capital, did we do any adjustments? Yes. Issue of shares. Issue of shares. Remember, for share capital, how much should we take? I'm going to credit share capital by 9,000. Share premium, I'm going to credit by 4,500. There you go. Simple as that. Revaluation. Do I have any adjustments to revaluation? Did we revalue? Did we do any revaluation? Yeah, this is my statement of, statement of, not other comprehensive income, statement of changes in equity, statement of changes in equity, changes in equity, it's not other comprehensive income, but are they asking me to do other comprehensive? Yeah, they require us to do other comprehensive income, we didn't do other comprehensive income. I'll come there, don't worry. Neha, thank you. So revaluation, what do we have for revaluation? There is a revaluation gain. How much is the gain? 4,000, not 40,000, it's 4,000. Done. Next, retained earnings. Retained earnings, profit or loss? We have a loss of minus 6,600. Are we clear? But now I have brought forward 5,100, then I have 6,600 negative loss, right, from here. So what is retained earnings? Opening brought forward retained earnings plus current year profit. Okay. But don't forget, there is a transfer from revaluation reserve to retained earnings. What is this transfer for? Excess depreciation. So depreciation excess. How much is the depreciation excess? I remember it was 500, right? So minus 500 here, and to retained earnings plus 500. Any other adjustments? Any other adjustments? Any other adjustments? Exactly, fraud, error. There you go. How much is the error? 1000. I have to deduct minus 1000. Now, guys, do you see? I never went to my notes. I always went to my workings. In the exam, you don't go to the notes at all. You only go to the workings. Done. That's it. Equals sum 54,000. Copy. Paste 9,500, 3,500, and then minus 2,000. All done. All done. I can come here and I can put my statement of other comprehensive income. So Fresco's statement of other comprehensive income for the year ended 31st March 2012. What do I have? There is a revaluation gain. How much is the gain? 4,000. And then there is excess depreciation. How much is that? Minus 500. Therefore, net gain will be here 35. Are we clear? Understood? That's it. Are we clear? Are we clear? Yes or no? Everyone? There's online. Are we clear? Quick, quick, quick. Okay, that's a 20-mark question that we have looked at. I know I've taken approximately 2 hours for it, but I was explaining you each and every point. In the exam, you can't take for this more maximum 40 minutes, not anything more than 40 minutes. So yeah, you need to make sure that you are in line with the timing. Okay, shall we take a break and then continue, or you want me to continue? What do you want me to do? But guys, how are you finding? Are you comfortable? Any areas of difficulties that you want me to help you further? Guys online? Neha, Akash, Tibi, Lingeshwari, Movin, Santosh, Shanuri, Shyamjit, Vasant. Vasant, you messaged me something, right? Can you work out a consultation sum? Okay, Akash. We'll do a consultation. Okay, everyone says consolidation. We'll do a cash flow also. Don't worry. Okay. Shall we? Okay. Why gym? P&L question? Okay. There you go. Go to the requirement. Okay, Vasant, I'll try to look at it by tomorrow. Okay. Requirement: calculate the consolidated goodwill at the date of acquisition, and then prepare the consolidated statement of profit and loss for YGEM for the year ended 30th September 2012. Two requirements: goodwill and then P&L can be tested. Goodwill with the P&L can be tested. Okay, take few minutes, go to the question on your own. Go to the question and give me a done. Done? Try to go through the adjustments. That's enough. He's got the provisions.
I think it's there in way also. Try to understand.
Okay, shall we start? Shall we start, everyone? Okay. Super. Now, guys, here the requirement is number one, calculate goodwill on acquisition at the date of acquisition of Reka. And number two, prepare the consolidated P&L for YGM for the year ended 30th September 2012. Okay. When you go to the question, okay, on 1st January 2012. Okay, now what I'm going to do is I'm going to take you through the question entirely. And we have done a P&L question earlier. No? I want you to do it on your own. And then I will do the answers with you again. Okay, so we can see where you're going wrong also. No? But I'll take you through the adjustments together. On 1st January 2012, YGM acquired 90% of the equity share capital of Reka in a share exchange in which YGM issued 2 new shares for every 3 shares it acquired in Reka. So here, number one, it's your investment cost, no guys. It's your investment cost. So basically, why is this relevant? This is relevant. This is relevant for your goodwill calculation. Additionally, on 31st December 2012, YGM will pay the shareholders of Reka 1.76 per share acquired. So based on the share that you are going to acquire, you are going to make a deferred payment of $1.76 per share. We have looked into it earlier also. YGM's cost of capital is 10% per annum. The deferred consideration has not yet been recorded by YGM, meaning you have to record it. At the rate of acquisition, shares in YGM and Reka had a stock market value of 6.5 and 2.5 each respectively. So basically, they are giving you the P&L and they are giving you the balance sheet. Now, if you are trying to work around the investment cost, right? If you are trying to work around the investment cost, you have 2 shares for every 3 shares it acquired. No? So there is a share exchange, number one. And there is a deferred payment. So you have to calculate that. You need to keep that in mind. So when you are going to do it on your own, you are going to do that calculation. Are we clear, everyone? Yes or no? Are we clear? Revenue, cost of sales. When I am acquiring on 1st of January 2012 and your year end is 30th September 2012, meaning it is a mid-year acquisition. We have looked at a question in terms of mid-year acquisition earlier also. So you need to make sure that your revenues and expenses are time apportioned. How many months? 9 months. Of subsidiary is time apportioned. Revenue, cost of sales, DP, distribution cost, admin, investment income, finance cost, profit before tax, profit for the year. What do you have? Equity shares and retained earnings. The following information is relevant. At the date of acquisition, the fair values of Reka's assets were equal to their carrying amount, with the exception of 2 items. They say at the date of acquisition, no. So basically, this becomes relevant for our goodwill calculation. The fair values of Reka's assets were equal to their carrying amounts, with the exception of 2 items. An item of plant which had a carrying value of 1.8 million above its carrying amount. So 1,800 is a revaluation surplus. So will it be relevant for my goodwill calculation? Yes or no? Will it be relevant for my goodwill calculation? Yes or no? Yes, because at acquisition, all the figures are relevant for my goodwill calculation. That's what I told you, remember? So when I'm calculating my goodwill, I will take this also. Consider this also. The remaining life of the plant at the date of acquisition was 3 years. So for 3 years, you will have to calculate depreciation. But here, when you are working on depreciation, you need to make sure you apportion it for 9/12 months, because only 9 months have gone. Are we clear, everyone? Greca had a contingent liability, a liability which YGM estimated to have a fair value of 450,000, meaning it's a liability which you have to deduct it from your retained earnings. So since it's at the rate of acquisition, you have to take the retained earnings and adjust for it. Greca has not incorporated these fair values into its financial statement, so you are going to incorporate it. Clear? YGM's policy is to value the NCI interest at fair value at the end of acquisition. For this purpose, Greca's share price at the date can be deemed to be representative of the fair value of the shares held by the NCI interest. They are saying, for you to calculate NCI investments, use the share price of the subsidiary. For example, total shares that our subsidiary has is 10,000 now. So to calculate NCI, basically what you will do is you will take 10,000. NCI percentage is how many percent? 10%. Our subsidiary's share value, they have given Greca is 2.5 into 2.5. That's going to be the NCI investment figure. Are we clear? Okay. Sales from YGM to Greca throughout the year ended 30th September 2012 had been consistently been 800,000 per month. So every month 800,000 for 9 months. 800,000 into 9 will be your intra-group transaction eliminated. So from here to here, intra-group sales eliminated from sales and purchases. YGM made a markup on cost of 25% on this sales. Greca had 1.5 million of this goods in inventory. So that is going to be your URP. Your URP is going to be 1,500 into 25 over 125. All these are straightforward, right? Guys, you understand? All these are straightforward, right? YGM's investment income is a dividend received from its investments in a 40% owned associate, which it has held for several years. The underlying earnings for associate for the year ended 30th September 2012 were 2 million. YGM's investment income. So our parent also has another associate. Are we clear? So it's not only a subsidiary, we have an associate also. So YGM's investment income is a dividend received from its investment in a 40% owned associate, which it had held for several years. The underlying earning for the associate for the year ended 30th September 2012 was 2 million. Meaning you will calculate associate share of profits, which will come to you. That will be 2,000 into 40%, which is going to be 800. Mervin, are we clear, Mervin? Yes or no? Brilliant. Okay. Now, YGM's investment income is a dividend received from its associate. Now, dividend received has to be eliminated. You have investment income of 500, has to be eliminated. That is also required. Although Greca has been profitable since its acquisition by YGM, the market for Greca's products have been badly hit in recent months, and YGM has calculated that goodwill has been impaired by 2 million. So there is a goodwill impairment of 2 million. So basically, if you have a goodwill impairment, you are going to debit your P&L, credit your goodwill. Whatever you do calculation here will be brought down by 2 million at 30th September 2012. So goodwill impairment also should be calculated. That's it. Are we clear? Are we clear? Everybody? You want to do it on your own? You want to do it on your own? Okay, brilliant. What I would want you to do is Do YGM on your own. Do YGM on your own. And then let's meet tomorrow at 6 p.m. to finish off YGM. Okay, 6:30, fine. Let's meet tomorrow at 6:30. Shadira wants me to do it at 6:30. 6:30 to finish off YGM. And let's try to meet on Tuesday as well. This week, let's try to meet. No problem. But tomorrow when you come, make sure that you have gone through YGM. And in the meantime, if you want me to do any other questions, further questions, just let me know. I'll try to accommodate it. Everybody, are we clear? Akash, Singeshwari, Maureen, Neha, Santosh, Shenuri, Shyamjit, Vasant. Are we clear? Can you do pyramid sum tomorrow? Okay, we'll do pyramid. I'll look into pyramid tomorrow. Okay guys, thank you so much for being here. And I'll see you guys tomorrow. Take care. Bye-bye. Primarily, I wanted to get connected to you because we had to do one question. I remember it is YGM. So we actually looked at the question together, right? And then I promised that we will answer this question together, right? This is the question, right, everyone? Everyone, this is the question that I was talking to you, right? Guys? Hello, others, can you hear me? Everyone, can you hear me? Everyone, can you hear me? We have a very bad weather in Sri Lanka. But anyway, we have already discussed the question. Okay, I'm gonna crystal clear. I'm gonna just start working around it, right? Now, number one, the requirement says calculate the consolidated goodwill at the date of acquisition of Greca. And number two, prepare the consolidated statement of profit or loss for the YGM group for the year ended 30th September 2012. So there are two requirements, and we have already read the question. And you know in the exam how we are going to answer. We are obviously going to leave 50 lines. We're going to leave 50 lines right to the bottom. We come to the bottom and we say number one, workings. That's the first thing that we're going to say, right? Which is W1 group structure. W1 is my group structure. Okay. Wasn't okay. Is there anyone from Aripro? Give me a hi. Anyone from Aripro who wants me to give you access for YouTube? Okay, there you go. Guys, just a moment. Okay. So W1 group structure. So when you go to the question, they say YGM acquired 90% of the equity share capital of Greca. We know that, and then this 90%. So for that, we are going to put up the group structure. There you go. So we have YGM acquiring 90% of Greca. YGM is the parent, Greca is the subsidiary, and then you have 10% NCI. Okay, that's done. That's done as always, right? Now, if it is the balance sheet, we will be doing the reserve section. So since it is not the balance sheet, we don't have the reserve section, right? We directly go to the notes. But before going to the notes, keep in mind always we have line by line addition to do. So I'm going to go to the top. I'm going to start working on my line by line addition. Okay. So YGM group of companies consolidated statement of profit or loss for the year ended 30th September 2012. So 30th September 2012. There you go. And in the exam, this is how it's going to look like, and I'm sure by now you had gone to the platform, seen the platform, started to work on the platform, answer questions on the platform, get access to the mock papers on the platform. I'm sure you've done all those, right? Now approximately we have 1 week for the exams, so that would have been done. Now when you read the question here, they say on 1st of January 2012 YGM acquired 90% of the equity share capital of Greca in a share exchange in which YGM issued 2 new shares for 3 shares in Greca. Additional 30th on 21st December 2012, YGM will pay the shareholders of Greca 1.76 per share acquired. YGM's cost of capital is 10%. The deferred consideration has not been recorded by we. You have to record it. As the date of acquisition, V's share price and G had a stock market value of 6.5 and 2.5 each respectively. And then you have the P&L. Okay, brilliant. Now that you've read that, you've understood it, you know our line by line addition is pending. We are going to work on the line by line addition. We have revenue. Don't forget, when I did this earlier last class, I told you 1st of January you're acquiring, your year end is 30th September, meaning it's a 9-month acquisition, so we call it a mid-year acquisition. If it's a mid-year acquisition, revenues and expenses of the subsidiary has to be time apportioned. So equals 64,600 equals 64,600 plus open brackets 38,000 into 9/12. Okay, now what you can do in the exam is this into 9/12 is there, no? When you're entering it the first time, you can copy it. Okay, 93,100. Then you have cost of sales. If you take cost of sales equals 51,200 plus open brackets 26,000. Whatever you copied, you can paste. Are we clear? 26,000, whatever you copied initially into 9/12, you can paste it. So that will give you 70,700. Gives you your gross profit. Now this is just to save some time in the exam. Okay. And then you have your distribution cost. You have your admin expenses. In the exam, you can always copy paste from there. You can copy paste. That option is there for you. Distribution cost is equals 1,600 plus open brackets 1,800. Copy paste. Whatever you copied in the first line, I'm pasting. Now see how I'm making use of my time. Even every 2 seconds that I spend, when I accumulate it, it's going to give me about 2 minutes, which is very important in the exam. So be smart in the exam, right? Equals 3,800 plus open brackets 2,400 plus whatever you copied. You're going to paste it. I'm getting it right. Okay. 2,400 into 9/12. Okay, 5,600. That is also done. And then you have investment income. Your investment income, they say, is equal to 500. You take the 500. And then finance cost equals 420. And then you have your profit before tax. And then obviously you have your tax for the year. So taxes equals 2,800 plus open brackets 1600 paste. Okay, why doesn't this paste? Into 9 over 12. 4000. Are we clear? Are we clear so far, everyone? Yes or no? Are we clear? Are we clear? Okay. Now our copy paste is done. Now it's a matter of taking the adjustments and making the adjustments as required. Okay. Don't forget we have two requirements: goodwill on acquisition and consolidated P&L. Okay. Now we are here now. Working two. On 1st of January 2012, we acquired 90% of the equity share capital group structure done in a share exchange in which we issued two new shares for every 3 shares it acquired in Greka. So working to investment cost. Share exchange. You're going for a share exchange. Okay. What is the basis of the share exchange, my dear? You are going for 2 new shares. 2 new shares for 3 shares it acquired. And YGM is giving shares, no? So whose share price is important for us? Relevant for us? 6.5 parent share price. Okay. Now when parent is issuing shares, what is how many shares are they acquiring? 90%. How many shares does our subsidiary have? Our subsidiary has 10,000 shares. Clear? So equals 10,000 shares. You're acquiring 90%. Your ratio is going to be 2 over 3 for every share you are issuing at 6.5. Are we clear, everybody? Yes or no? Are we clear, everybody? Yes or no? Everybody, yes or no? 39,000. Okay, so that is that. And then they say additionally on 31st December 2012, YGM will pay the shareholders of Greka 1.76 per share acquired. So then number 1, share exchange. Number 2, what do you have? You have a deferred consideration. 2 things. Deferred payment. Now when you take the deferred payment, they say they will pay 1.76 per share acquired. In total, our subsidiary has 10,000 shares. You are acquiring 90% into 1.76, 15,840. Therefore, 15,840 is your future value. Your future value is 15,840. Therefore, your present value will be future value, present value equals future value over 1 plus r to the power n. You know the formula by now. Equals 15,840 over 1 plus cost of capital they have given us 10%. 1 plus 0.1. When are you paying? You are going to pay as at today, this year end, to the power 1. 14,400. Are we clear? Everyone, yes or no? Are we clear? Yes or no? Yes or no? Clear? Okay, superb. Now basically therefore relevant for goodwill. Total investments relevant for goodwill will be equals 14,400 plus 15,800. Sorry, 14,400 plus 39,000. That's my 53,400 relevant for my goodwill. Are we clear? Okay. Now guys, you need to understand, if you have a deferred payment, you're deferring your payment, a liability. For that there is cost of capital. On that you have to pay unwinding discount. So W3, finance cost. Finance cost. Now what is your present value? Your present value is 14,400 from here. Your finance cost, they say, is 10%, correct? So equals 14,400 into 10%, but into 9 over 12. 1,080. 1,080 is your finance cost. Are we clear? Are we clear? Yes or no, everybody? Okay, now you have to account for the finance cost. No, you already have 420 plus 1080 in the current year, 1500. Did you understand that adjustment, everyone? Did you understand that adjustment, everyone? Okay, brilliant. Understood. Okay, so that's done. So entirely, guys, remember, if you get a share exchange, you need to account for share exchange, but you need to take parent share value. Number two, if there is a deferred consideration can result in finance cost. So you have to account for the finance cost. So that is done. We go right to the bottom. The following information is relevant. At the date of acquisition, the fair values of Greycast assets are equal to their carrying amount, with the exception of two items. What are the two items? An item of plant had a fair value of 1.8 million above its carrying amount. Okay, what does that mean? What is that? Working number 4. What is it? There is a revaluation gain. There is a revaluation gain. Okay, revaluation gain of how much? 1800. So revaluation is happening at acquisition, correct? So therefore it's relevant for my goodwill calculation. I'll put a note. Remember, I have to calculate my goodwill also, no? So 1800 revaluation gain. Will that have an impact? Will that have any impact on my P&L? Yes or no? Will that have any impact on my consolidated P&L? Yes or no? Well done, Mervin. No impact in my consolidated P&L. Okay? Superb. So I'm going to go forward and they say the remaining life of the plant at the date of acquisition was 3 years. Depreciation is charged to cost of sales. So working number 5, automatically we have depreciation to calculate. Okay. Okay. Superb. Now depreciation. How do you calculate? Equals 1800 divided by 3 years, which is 600. But out of this, into 9/12 is what is relevant for us now. 450 is relevant for us, correct? Because 9 months are now gone, guys. So you have to always make sure that you account for 9 months. So it is charged to cost of sales. So I go to cost of sales, 7700 plus 450. Are we clear? Are we clear? Are we clear? Okay, superb. Next, working number 6. Greyka had a contingent liability. This is at acquisition, right? Greyka had a contingent liability which YGM estimated to have a fair value of 450. Okay, contingent liability. Contingent liability of 450 at acquisition, meaning it becomes relevant to my goodwill calculation. Okay, you need to keep that in mind. Okay, let's go further. Greyka has not incorporated these fair values into its financial statements. You have incorporated it. You have done it. YGM's policy is to value NCI interest at fair value at the date of acquisition. For this purpose, Greyka's share price at that date can be deemed to be representative of the fair value of the shares held by the NCI interest. This is for NCI goodwill. So you don't have to bother anything about anything. So W7 NCI investments will be based on share price. So we can calculate that. No problem. Next, what do they say? Sales from YGM to Greyka. So from parent to subsidiary throughout the year ended 30th September 2012 had been consistently 800,000 per month. So for how many months did you make the sale? So intra-group transaction, you are paying 800,000 every month. Am I right? So equals 800 into 9 months. Therefore 7,200 eliminated from where? Sales and cost of sales, purchases. Guys, in the exam, this 800 into 9 working is there, right? You don't have to show separately. 800 into 9, you don't have to show that, okay? If you just put it in the cell, your examiner will go and check that out. You don't have to worry about it. Now, for example, here, you don't have to show the examiner how you got 93,100. Your examiner will understand that. Are we clear? Are you clear? He's supposed to go to the cell and check. Now, I have to remove the intergroup transaction. How much? 7,200. Eliminated. Minus 7,200. Done and dusted. Let me go further. Guys, so far, am I clear? Am I clear, everyone? Am I clear? Okay. YGM made a markup on cost of 25% on the sales. Greca had 1.5 million of these goods in inventory as of 30th September 2012. Okay, so that means URP. Guys, we have looked into it so many times. We have looked into it. Okay, this is a testable area in the exam. So it is tested. So you got to make sure that you are ready for it. URP. Now URP, what is happening, guys? You have 1,500 value of goods into 25% equals 1,500 into 25 over 125. Clear? Which is 300. Eliminated. Who is the seller? Seller is YGM. So eliminated from V. You need to make sure that you put that also. YGM's investment income is a dividend received from its investment in a 40% owned associate which it has held for several years. Okay, now our group structure is going to change. Okay, YGM does not only have 90% of Greca, it has 40% of some other company called associate A. 40% associate. So your group structure is changing. There you go, and then you can come back. And they say the underlying earnings for the associate for the year ended 30th September 2012 were 2 million. Okay, two things. You have a dividend received from a 40% investment. So the working number 10, you have intergroup dividends. Intergroup dividends, you will obviously go and eliminate it. Why? Because you're going to add the profit share of the associate. Because you're going to add the profit share of the associate, you're going to eliminate the dividends. If not, it will be double counting, guys. So eliminate how much? Investment income is 500. Eliminate 500. So I go to the top. I come here. I come to investment income minus 500. It becomes 0. Okay, that's done. And then, guys, yes, we have eliminated the investment income, but there is what? There is 2 million that you are receiving, right? So that is your share of profits. So share of profits has to be added. So W11 associate share of profits. Okay, how much is the total share of profits? You are receiving 2000 equals 2000 into 40%. That's going to be how much? 800. So this is the associate share of profits you are receiving, right? So therefore, what you can do is you can come here. Investment income is 0. So therefore, I can say associate share of profits 800. Guys, however, I am taking the entire 800 only because they say it is there for several years. But if it is months acquired halfway, then I'll have to apportion that as well. Are we clear? I'll have to apportion that as well. Are we clear? Are we clear? Okay. Although Greca has been profitable since its acquisition by YGM, the market for Greca's products has been hit badly, and YGM has calculated that there is a goodwill impairment of 2 million. So working number 12, impairment of goodwill. Now, what do you have? Impairment of goodwill. You have 2000, but in this 2000, 90% is parents. Out of this 2000, 10% is NCI. So probably equals 2000 into 90%, and then you have 200. Now in the exam, you don't have to show this. If you just put this itself, it's good enough to get your marks. Are we clear? Are we clear? Are we clear? Superb. Now that we are done, we can start getting the answers here. So obviously 85,900 minus 63,950 gives me 21,950. That's my gross profits. So my profit before tax will be equals 21,950 minus distribution cost minus 21,950 minus distribution cost minus 5,600 plus associate share of profits minus finance cost gives me how much? 12,700. From 12,700 I deduct 4,000. 8,700 will be my profit after tax. Hopefully I got it right. Did I get everything right? Did I make any mistakes? 21. So URP. Okay. URP has not been adjusted. Didn't I adjust URP? Oh. There you go. 300 URP has not been adjusted. So plus 21,650 and then 2,950, 5,600 and 800 and then 1,500. 12,400 minus 4,000. 8,400. Okay. All good. All good. All good. Did I get my calculations correct? Did I get my calculations correct? So impairment of goodwill. There you go. Yeah. We have impairment of goodwill, right? So basically there is impairment of 1,800 can be allocated, can be added here. Now clear? 6,600. There you go. That's done. Impairment. Adjusted. So now we have our profit after. So these are group profits. Contingent liability. What to do? Contingent liability is accounted in the goodwill, right? We have to take it to goodwill, right? And a liability as an acquisition. So that will be adjusted there. So group profits 6,600 done. Now I have to calculate NCI share of profits. There you go. So next would be NCI share of profits, and let's start working on NCI share of profits. So if you are done with NCI share of profits, obviously we have to do the goodwill calculation. With that we are done. So basically NCI share of profits, I need subsidiaries profits, right? Subsidiaries profits. So how much is subsidiaries profits? How much is subsidiaries profits, everyone? How much is subsidiaries profits? Calculate. How much? Give me subsidiaries profits quick. Subsidiaries profit is given as NCI share of net assets. I need subsidiaries profits 6,200. But then again, it's not actually 6,200. 6,200 into 9 over 12, because I have it only for 9 months, right? So 6200 into 9 over 12. Are we clear? Because the remaining 200 is a part of NCI. Neha, the remaining 200 is for NCI. Probably Kaplan would have taken the entire 2000. Please don't take it. The remaining 200, take it to NCI. Because it's the total goodwill, right? The goodwill has been impaired. So entirely it's been impaired. So the remaining 200 will be taken to NCI. So I'll show you how to do it. Don't worry. Okay. I remember Kaplan has taken the entire 2000. But let's apportion. Now here subsidiaries profit 4650 and all other adjustments should be considered. What are the adjustments? If you come here, you have depreciation of 450. So you can come to the top. Depreciation minus 450. You have impairment of 200. Post acquisition, all adjustments, impairment 200 relevant. That is relevant for subsidiary only. Okay. URP will it be relevant? URP will it be relevant? No, because the parent is selling. Brilliant. So that's it. So equals sum 4000. Correct. No. No. Because, hold on. 4650, right? 4650, in that the share relevant to NCI is only 10%, right? There you go. 465. From that, depreciation equals 450 into 10%, right? Relevant 45. So either I can take it like that, or what I can do is, there is another way to take it. Okay, it's a simple way. I can take 4650 and I can take 450 equals this minus this 4200. In that, NCI share is 10%. So I'm going to give the same answer, equals this into 10%, gives me 420. From this, I can deduct impairment. Remember, was 200. Therefore, 220 is your NCI share of net assets. Neha, I've taken the impairment here. You understand? Out of the 2000, 1800 on top, 200 here. So this is my NCI share of. Neha, understood? Please take it like this, because only then we can apportion it. Okay. Now that we are done with that, we can also look at goodwill on acquisition. That's our another requirement. Guys online, did you understand? Guys online, all of you, did you understand? Okay, for goodwill, I need my investment cost. Investment cost of parent and NCI, correct? Parent's investment cost, we calculated on top, right? Remember, 53,400, we calculated already. NCI investment, we are supposed to use the share value, correct? Subsidiary has 10,000 shares, 10%, and the share value that we are going to use for this calculation is going to be 2.5, because subsidiary share will be relevant to calculate subsidiaries NCI. So into 2.5, guys, all this we have studied in our previous lessons also. Correct? That's done. From this acquired net assets, what do we require? Share capital. Share capital, we know already it's 10,000. Are we clear? And then we require retained earnings at acquisition. Okay, retained earnings at acquisition. How much is it, everyone? Retained earnings at acquisition, how much is it? Anyone? Anyone? Retained earnings at acquisition, anyone? Let's see who's getting it right. Retained earnings, guys, retained earnings, how much is it? Neha says 35,000. Any other answers? Any other answers? Anybody? Guys, it's a bit disappointing. You're unable to give me answers. It's a bit disappointing. You're struggling at this point. You can't struggle. You can't struggle. Retained earnings at acquisition. Goodwill is at acquisition. Retained earnings at acquisition. Okay, now what you're giving here is 35,000 on 1st of October 2011. This is on 1st of October 2011. You are acquiring on 1st of January. You are acquiring on 1st of January, my dear. You're not giving me the correct answers. I'm so sorry. Until 1st of October 2011, yes, it's 10,000. But I want acquisition. Vasant has given me a figure. Let's say. Okay, now guys, this is where most of you are getting yourself confused. Now look here. Now if you try to put up a little timeline, right? Okay. Now your year end is 30th September 2011. Your year end is here. 30th September 2012. You would have started from 1st of October 2011, but you are acquiring on 1st of January over here, 1st of January 2012. So I want retained earnings at this point. Here they are given us retained earnings on 1st of October 2011. So 1st of October 2011 it is 35,000. I understand that. As of today, what is the retained earnings? Now you can't mess up there. One last time I'll explain you. Look here. One last time I'm going to explain you, guys. This is very important. During this period, you have made a profit. Subsidiary has made a profit of 6,200. 6,200 is for how many months? 12 months. So if you are moving from here, 35,000, October, November, December, for 3 months you need profits, correct? 6,200 into 3 over 12. That will give you your retained earnings at acquisition. Guys, please don't play with that. Please take that serious. I've already done about 3 to 4 questions there, right? 35,000 and then profit adjustments 3 over 12 equals 6,200 into 3 over 12, 1,550. If it is loss, you will deduct. If it is profit, you will add. There you go, 36,550. And you will adjust everything at acquisition. Everything at acquisition. What is there at acquisition? At acquisition, there is revaluation 1,800. At acquisition, there is, you see, at 450. So 450, we have a contingent liability. Minus 450, you will adjust. And then what will you adjust? Revaluation. There was a gain. How much is the gain? Gain is 1,800. You will adjust that, so equals 1,800. Therefore, in total, 47,900. In that you are acquiring 90%. So equals this into 90% is 43,110. 53,400 minus 43,110. That's your goodwill on acquisition. And then you have NCI. When you're taking NCI 2,500, but here what is happening is equals 47,900 but 10%. So equals this into 10% is 4,790. So you have 2,500 minus 4,790. You have 2,290 negative. Are we clear? Yes or no? Are we clear? Are we clear? It's a negative goodwill. Now guys, don't forget, your total goodwill is this, but from this there is impairment of minus 2,000. Therefore, your goodwill to show in the balance sheet would be 6,000. Guys, we've done questions like this. Before, and I don't know why you're getting confused. It's a straightforward question. Do you understand? Yes or no? Everybody, do you understand? Yes or no? Are we clear?